Morning everyone. So before we start with today's class, let us quickly glance through what was done in the previous class. So in the last class we discussed the basic aspects, okay, basically the introduction pertaining to what exactly is companies, what are different types of companies, okay, so what are the statutory books which has to be maintained by the company, okay, and then like what exactly is the audit process, okay. So these are the basic aspects what we had discussed in the previous class. So let's quickly glance through that. So when it comes to company, okay, what is a company? So according to the definition, if you see, company is nothing but a company which is registered under the existing act or any other previous law. Okay, so all these things are available in the notes if you see. So this notes you guys will be able to get the access of. Look at this. This is the definition. So company is nothing but a company which is incorporated under this act. This act is nothing but the Companies Act 2013 or any other company, okay, or any other existing law. Now let us say before this Companies Act 2013 we had a law called as Companies Act 1956. Now if at all there is any company which is incorporated under that particular law, okay, even that would be considered as company itself. Clear? Okay. So this is the definition, okay. So company is nothing but a company which is incorporated under this law or any other existing company. Existing company is nothing but the company which was incorporated or formed under any of the old law. Clear? So if you just go through this meaning of the term company, company is nothing but an artificial person which is created by law, having separate legal entity, perpetual succession and a common seal. So what is separate legal entity? So once company is incorporated, it will be having its own identity in the eyes of law, okay. So if at all the company wants to purchase any assets, it can still purchase the assets in its own name. If at all the company wants to have any obligation, if at all the company wants to take any loan, it is still possible for the company to borrow the money in its own name. Clear? Same way, if at all the company wants to put a case on somebody, okay, or file a case on somebody or sue somebody, it is possible. Or if somebody else wants to put a case on the company, even that is possible. Clear? So just because it is registered, remember I told you company can come into existence only if it is registered or incorporated. Company can never come into existence without incorporation, okay. So company can basically take birth only after registration. Clear? Remember this point. So that was separate legal entity. When it comes to perpetual succession, it is as good as it will be having a continuous existence, okay. So it's not like company will end its process. So there might be changes in the ownership or there might be changes in the management, but company will continue carrying on its operation throughout, okay, for an indefinite period of time. Clear? And then when it comes to common seal, as I mentioned you, so in order to call any document as authentic one or genuine one, it would be carrying this common seal. And remember I told you one separate person will be in charge of using this common seal. It's not like every person will be having access to this particular common seal. Only a particular person, okay, who is authorized, okay, only he can use this particular common seal, and he'll be maintaining a register as well on what and all document did he use this particular common seal. Clear? Now look at the features. So first thing is it is an artificial person which is created by law. So separate legal entity. So once it is incorporated or registered, it will be having its own identity in the eyes of law, okay. So company can purchase assets, the same point what we have already discussed. So company can sue or be sued. Clear? Again discussed. So company is treated as a separate artificial person in the eyes of law, okay. So if the company wants to put a case on somebody or if somebody wants to file a case against the company, it is still possible, okay. So no restriction with respect to transferability of the shares, but when it comes to private limited company, okay, can the shares get transferred? No. So remember when it comes to private limited company, we discussed the meaning of this particular term. So there will be basically 3 restrictions. What are those? First thing is with respect to transferability of the shares, okay. So in case of private limited company, so there is restriction with respect to transferability of the shares, okay. The shareholders cannot transfer their shares to somebody else when it comes to private limited company. The second restriction is it will be limiting the maximum number of members to how much? 200, okay. So a private limited company cannot have more than 200 members. Clear? And then the third restriction is it will be prohibiting raising funds from the public, okay. Private limited company cannot raise the funds from the public. Clear? So these are the 3 restrictions. Public limited company, the meaning would be very simple. So any company other than private limited company would be treated as public company. So basically when it comes to public limited company, there is no restriction with respect to transferability of the shares, no restriction with respect to upper limit of number of members, that is maximum number of members. And then when it comes to raising the funds from the public, a public limited company can always raise the funds from the public. Clear? Okay. So company which is an artificial person, it cannot run on itself. Therefore, when it comes to management, it is taken care by a separate body called as what? Called as board of directors. Okay, so these will be the people, or this particular people will be responsible for preparation of financial statement and taking care of day-to-day affairs of the business. Clear? So then we discussed about different types of companies. Okay, so company limited by shares. Remember, the liability of members will be limited only to the extent of what? Unpaid value of the shares which is held by them. Okay, so if you guys remember this particular example, remember this. So if Mr. A is holding 1000 shares of 100 out of, so total capital will be 1 lakh. Out of this 1 lakh, if he has already paid 60,000, his liability will be restricted only to the extent of balance unpaid value of the shares which is held by him, that is 40,000. So at no point of time the company can demand more than 40,000 rupees from this particular shareholder. Okay, because the liability of shareholder is always limited to the extent of what? Limited to the extent of unpaid value of the shares which is held by him. Clear? Okay. So then when it comes to company limited by guarantee, now what is this guarantee? At the time of incorporation, okay, or registration, so these members would have given guarantee that in the event of winding up or liquidation, we'll be contributing so much of fund towards the assets of the company. Okay, so if me being a shareholder, if I've given a guarantee that in the event of winding up or liquidation, I'll be contributing 2 lakh rupees. Clear? So my liability will be limited to what extent? My liability will be limited only to the extent of that particular 2 lakh rupees. Okay, so I need not pay even a single penny more than that. Okay. So then when it comes to private limited company, we have already discussed these 3 points. Restriction with respect to transferability of the shares. So limits the maximum number of members to 200 and prohibits raising funds from the public. Okay, so public company, any company other than private limited company. Now what is this one person company? So this was a new concept which was introduced in this Companies Act 2013. So here even a single person, okay, can do the business or can run the business in the form of company. Clear? So earlier, remember, single person doing business, it was just proprietorship concern, but here a single person can also form a company and carry on the business. Clear? He himself will be the sole member and director. So what about small company? Very first point to remember is, can a public limited company be a small company? No. Look at this definition. It refers to a company other than public company. Clear? So whenever a particular company is a public limited company, straight away it is not a small company. Okay, so in order to come in this particular criteria of small company, it cannot be a public company, as simple as that. Okay, so public company, straight away it can never be called as small company. Okay, even though its paid up capital is well within the limit, or even though its turnover is well within the limit. Now what are the limit? When it comes to paid up capital, it would be 50 lakh rupees, and when it comes to turnover, it would be how much? It would be 2 crore rupees. Clear? Hope you guys understood this. Just a second. Yeah, so now I think it is visible to you all. Now look at this. So after this, we discussed about quite a few cases. Okay, and what about the conditions? Is it that only one condition needs to be fulfilled, or is it that both the condition needs to be fulfilled? So both the conditions should be fulfilled. That is, the paid up share capital should be well within 50 lakh rupees, and when it comes to turnover, it should be well within this 2 lakh rupees. Okay, and these limits, can it be extended? Yes, of course. Okay, so these particular limits can be extended by the law, but making sure that the maximum can be only 10 crore pertaining to paid up capital and 100 crore pertaining to turnover. Okay, so whenever the Companies Act wants to amend these particular criteria, okay, or these particular limits, okay, it can still do, but making sure that the paid up share capital should not be exceeding 10 crore and turnover should not be exceeding 100 crores. Yeah. Okay, so then we discussed about not-for-profit company, or it is also called as Section 8 company. Okay, so these particular companies are run mainly with an objective of not making any profit, rather promoting some art, science, culture, sports. Okay, so anything like that. Look at this. So these are the companies which run with an intention of promoting art, science, culture, religion, sports, or any other activities for that matter. Okay, like protection of environment or anything for that matter. Okay, so then when it comes to listed company, what are these listed companies? So these are nothing but the companies whose shares are listed in the recognized stock exchange. Okay, so these particular company shares will be recognized in the or will be listed in the recognized stock exchange. So then we discussed about the books of account which has to be maintained by the company, what exactly are the statutory registers, okay, and what exactly is annual return and all, okay, all these basic aspects we discussed, and we are supposed to start with the main aspects pertaining to this particular chapter, that is issue of shares. Okay, so let's start from here. So before starting up with this particular part, issue of share, we should be having clarity about what exactly is the meaning of this particular term share. Okay, so let's look into it. Any idea what is the share? Yes, what is the share? So what is capital? So before we speak about this particular term share, let us understand the meaning of the term capital. So what is capital? So don't you think capital is nothing but the fund which is contributed by the owner, right? Correct? So capital is nothing but the owner's contribution. So the money which is contributed by the owner, that is the thing which is called as capital. Now why do you think the owner will be contributing some funds? So obviously he'll be expecting some return from the business, right? Correct? So if I'm carrying on the business and if I'm investing, let's say 20 lakh rupees, it's not that I put 20 lakh rupees and after 20 years I get back 20 lakh rupees. No, right? I'll be expecting some return. Okay, so any investment whenever a person makes, obviously he'll be expecting some return. Okay, so when it comes to business, that return is nothing but the profit. So capital is nothing but the contribution which is made by the owner. Okay, now in case of proprietorship, it would be called as what? Proprietor's capital. In case of partnership, it would be called as what? It would be called as partner's capital. And when it comes to company, okay, so it's not that it is called as company's capital. No, it is called as what? It is called as share capital, because the owners, okay, so look at this, the owners when it comes to proprietorship is who? The proprietor himself will be the owner, so it would be his capital, proprietor's capital. When it comes to partnership, who will be the owners? The partners will be the owner, that is why it is called as partner's capital. But when it comes to company, who are the owners? The shareholders, right? Correct, so that's why it is called as share capital. You can either call it as shareholders fund or share capital. Clear? Okay. Now what is the share? Now you understood what is share capital, right? This is nothing but the owner's capital when it comes to company. Now what is the share? So basically the definition of share goes like this: a share is a share in the share capital of the company. Okay, so a share is a share in the share capital of the company. Clear? Now let us say the total company share capital is 10 lakh rupees. So 1 lakh shares of rupees 10 each. Okay, so this 10 lakh rupees of share capital will be divided into small shares. Okay, so this 1 lakh number of shares, it would be called as shares. So look at this, total share capital, let's say is rupees 10 lakh. Price per share, let's say rupees 10. Number of shares will be how much? Number of shares will be 1 lakh. So this particular share capital of 10 lakh rupees, it would be divided into small shares, okay, or small portion. That small portion is what is called as shares. Look at this. This 10 lakh rupees is divided into small units. Okay, so 1 lakh units of rupees 10 each. Clear? So this 1 lakh is what is called as number of shares. Okay, now look at the definition. A share is a share in the share capital of the company. This is the share capital of the company, 10 lakh. Out of this 10 lakh, what is the share? It is a small portion. Okay, so look at this. This 10 rupees, okay, is the price per share. So therefore the number of shares will be what? 1 lakh. Clear? Okay. Now look at this. Okay, let me just briefly make you guys go through this particular information which is available in your study material. Not much important from examination perspective. Let me just quickly go through these particular aspects. Now, significance of capital in a company. Now, what is the significance or importance of capital in a company? Any business for that matter, can you guys imagine it without money? Can any business run, okay, or get started, okay, without any capital contribution or without any investment? Can you guys imagine any business without money? No, right? Even if you guys are opening a small tea stall, okay, money is required. So without money, basically there is no business. Now what exactly is significance of this particular capital when it comes to company? Okay, so what might be the reason? in order to take care of the day-to-day requirement. Okay, don't you think money is required? Now when you're starting up a company, don't you think you need to buy fixed assets? Now from where will you be buying these fixed assets? Don't you think money is required? So let's have a look into what exactly have they given. Look at this. In order to finance procurement of resources and to run its operation, every company requires capital. Okay, in company form of organization, this capital is raised not only from the promoters but also from others in the society, that is public. So this particular fund, okay, that is capital. Okay, so it's not that it will be raised only from the promoters. Okay, so this will be raised even from the public. Now how will they raise funds from the public? They'll be issuing something called as shares. Okay, now when they're issuing the shares, okay, they'll be receiving the money. So what journal entries will we be passing, okay, with respect to all these transactions? Okay, that is what we'll be discussing in this particular unit. Okay, so look at this. So money whatever they are raising, okay, so it need not be the money which is raised only from the promoters. Okay, it can also be the money which is raised from the public, okay, or institutional investors. Okay, so remember, so FDI and FII, okay, foreign institutional investors, okay, FII, okay, so foreign director investors, okay, so foreign direct investors. So these are basically the institutional investors. Okay, even the institutes can invest in the shares of a particular company. Clear? So this allows a traditional company other than one person company to raise huge amount of capital to finance operation at a large scale. Hope you guys understood. So basically in order to carry on the operations, okay, so or run a particular business, money is required. That money will be raised from whom? It would be raised from promoters as well as public in large. Now how are they going to raise the funds from the public? So what they'll be doing is they'll be issuing something called as shares. Okay, so public will be subscribing for those shares. Okay, they'll be literally paying the money and becoming the shareholders. Okay, so all these money which the company is raising from the public, okay, so that would be treated as share capital. Clear? Okay, so let's have a look at the concept of shares and share capital. Okay, it's not much important again. So when it comes to definition, look at this definition. Just remember this much more than sufficient, which we have already understood. Look at this. Section 2, and how are we going to read this? This would be section 2 clause 84. Okay, so look at this. Section 2 clause 84 of the share means a share in the share capital of the company. Okay, a share is a what? A share is a share in the share capital of the company. Clear? Now what are the features of shares? So shares will be having the following features. Okay, so let's look into what exactly will be the features of this. It represents the smallest unit of the ownership. Remember I told you this particular share capital of 10 lakh rupees will be divided into small units of 10 rupees. Okay, so which would be called as share. So share is basically a smaller unit in the total share capital. If the total share capital is 10 lakh rupees, how much is the least price? Look at this, the price per share is 10 rupees. Okay, so 1 lakh rupees would be the number of shares. So these are nothing but the smallest unit. Then the second feature is each share has a specific value. Okay, so it will be having what? It would be having a specific value. Share of a specific series must have the same face value. Now there will be, it's not that the company should be issuing the same face value shares. Okay, now let us say the company wants to raise some additional capital. Okay, additional funds. So initially the company issued the shares at 100 rupees. Now subsequently the company can issue the shares at 120 or 130 also. Okay, depending upon what exactly is the demand of this particular company share in the market. Okay, or depending upon the market value. Clear? So share of a specific series, okay, must have the same face value. Okay, share represent only a partial ownership of the share capital. Look at this. Okay, so share will be representing what? Only a partial ownership of this particular total capital. Why? Because share is basically a share in the total share capital. Now let us say here we have got 1 lakh shares. Okay, out of this 1 lakh share, Mr. A is holding, let's say, 10,000 share. Okay, now we should be considering the total share capital. In order to decide how much is the total capital of the company, we need to be looking at this particular figure of 10 lakh and not just the amount which is held by this particular shareholder, Mr. A. Okay, so when you're talking about the share capital, you need to look at this particular total value. So that's why here they say that share will be representing what? It would just be representing the partial ownership. Okay, so shares are transferable. You guys already know this. Okay, we've already come across this particular point when it comes to features of the company. Shares are easily transferable only except in case of private limited company. Okay, so look at this. So shares are transferable and thereby ensure perpetual succession of the company. Okay, so company will run throughout. Okay, if you don't want to be a shareholder, you can easily transfer your shares to somebody else and you can exit from that particular company. Now just because you are exiting from the company, it doesn't mean that the company will get closed. Okay, so company will be having a continuous existence. Okay, perpetual succession. Basically there's no end for the company. But for a shareholder, okay, if he wants to cease to become a shareholder from the company, what he can do is he can just transfer his shares to somebody else. Okay, so there's no restriction with respect to transferability of the shares. Till the point you're carrying on or you are holding these particular company share, you will be treated as owner of the company. The moment you transfer your shares to somebody else, okay, you cease to become the shareholder or the member. Okay, now just because you're ceasing to become a shareholder, it doesn't mean that the existence of the company will come into end. Okay, so company will continue its operation throughout. So that's why normally we say it in this way. So there might be changes in the ownership. How do you think there will be changes in the ownership? So one person transferring the shares to the other person. Okay, the other person will become the owner in his place. Clear? So there is some changes. Just because there is some changes which is happening in the ownership, it doesn't mean that the business will come to an end or the company will come to an end. So company will be having perpetual succession, that is continuous existence. Clear? So each share has distinct number. Okay, so here if you see, okay, so totally the company would have issued 1 lakh shares. Now these entire 1 lakh shares will be having its own serial number. It's not that all the shares will be having the same serial number. It will be having its own distinct number. Hope you guys understood this. Not important from examination perspective. Okay, so let's have a look at this. So whatever is important, guys, I'll be writing in this particular notes. Okay, you guys can just go through this. Okay, so the things which are not important will not be wasting too much of time on that. Okay, so let's talk about these types of shares. So basically shares, okay, can be divided into two types. Okay, so what are these? So one is preference shares and equity shares. Now what are these preference shares and what are these equity shares? Okay, so preference shares, if you guys remember, I already told you the meaning of this. So these are nothing but the shares which will be having preferential right with respect to what? With respect to payment of dividend and repayment of capital. As the very name suggests, preference shares, okay, will be giving some kind of preference to these people. Okay, so these are the shares which carry preferential right with respect to payment of dividend and repayment of capital. Okay, so these particular shareholder will be having preference. So whenever the company wants to pay the dividend, okay, so initially it will be paying the dividend to whom? It will be paying the dividend to the preference shareholders, and only at the end will be making the payment to the equity shareholders. So here basically the company will be giving some kind of preference to the shareholders with respect to payment of dividend and repayment of capital. So what are these equity shares? So equity shares are nothing but the shares other than preference shares. Okay, so these are the shares other than preference shares. So any shares other than preference shares would be treated as equity shares. So what I mean to say is these shareholders will not be having any preference with respect to payment of capital and payment of dividend. Clear? So basically we will not be giving any preference to these equity shareholders. Only at the end, if there is still some surplus money which is left over, so these equity shareholders will be entitled to get a share in that particular money. Okay, so initially we repay to everyone. At the end, whatever is the leftover amount, so that leftover amount will be distributed to the equity shareholders. Now when it comes to preference shareholders, okay, we have got different types of preference shareholders, okay, or preference shares for that matter. But when it comes to equity shares, we don't have anything like that. Okay, so these preference shares can further be classified into various types. Okay, so let's talk about those. So types of preference shares. Okay, now let us understand what exactly are the different types of preference shares. Okay, so look at this particular chart. So based on redeemability, okay, so based on conversion rate, okay, based on nature of dividend, based on accumulation of dividend, so based on participation rate, okay, so we've got different classification. So let me briefly explain you the meaning of these stuffs, and after that we'll be writing the same in the notes. Okay, so look at this. So based on redeemability, okay, so what do you understand by this particular term redemption? You guys would have heard about this particular term, right? Redemption. Okay, so what is this redemption? To redeem means what? To redeem is nothing but to repay. Okay, so redemption is nothing but repayment. So we would have raised the funds from the preference shareholders. After a certain period, if we are repaying this particular amount back, it would be treated as what? It would be treated as redemption. Okay, so redemption is nothing but repayment. Okay, so look at this. So based on redeemability or redemption, it would be classified as redeemable shares and irredeemable preference shares. Okay, so remember here we are talking about what? We are talking about different types of preference shares. Okay, so based on redeemability, we have got redeemable preference shares and irredeemable preference shares. Okay, or you can call it as redeemable and non-redeemable. Okay, so based on conversion rate, okay, so we have got convertible and non-convertible. Okay, so let me tell you what are these redeemable preference shares and what are these non-redeemable preference shares or irredeemable preference shares. Okay, so redeemable pref shares, okay, or redeemable preference shares. To redeem is nothing but to repay. So these are the shareholders which will be repaid after a certain period of time. Okay, if I'm issuing the shares today, and what about the redemption value? It would be decided, okay, initially only that these particular shares will be repaid at so and so value. Now after a certain period of time, if I'm redeeming it or if I'm repaying it, okay, so it would be called as what? It would be called as redeemable preference shares. So basically when it comes to redeemable preference shares, these shareholders will be getting back their capital before the company is liquidated or wound up. Now what about irredeemable preference shares? When do you think they'll be getting back this particular amount, whatever they had contributed initially? So these non-redeemable or irredeemable preference shares, these people will be getting back the money only in the event of liquidation or winding up. Okay, so until and unless the company is not liquidated, these people will not be getting back their amount. Clear? So when it comes to redeemable preference shares, let me just write the meaning of this. So these are the shares which will be getting back the capital after certain period of time. Okay, to redeem is nothing but to repay. Okay, the company will be repaying these particular preference shareholders. Okay, so whatever amount they had contributed initially, these people will be getting back that amount after certain period of time. Clear? So then when it comes to the second type, irredeemable preference shares. Now what are these irredeemable preference shares or non-redeemable preference shares? Now these people will be getting back the amount only at the time of liquidation or winding up. Okay, so till the point the company is there in existence, these people will not be getting the amount. Okay, so these people will be getting back the amount only in the event of liquidation or winding up. Okay, so these shareholders shall get back their capital or amount only in the event of liquidation or winding up. Okay, so only in case of liquidation of the company or only in case of winding up of the company, these people will be getting back the amount. Okay, so until and unless the company is not liquidated, okay, so these people will not be getting back that amount. Okay, so that is irredeemable preference shares. Clear? Now based on conversion rate, okay, so based on conversion rate, we have got convertible preference shares and non-convertible preference shares. Now what are these convertible preference shares? So these are nothing but the shareholders who will be having the option of getting converted into equity shares. Okay, so these shares shall have an option of being converted into equity shareholders. So basically the shares which will be having the right to get converted into equity, okay, so that would be called as convertible preference shares. So convertible preference shares are basically those shares which can get converted into equity shares. So initially I'm a preference shareholder. If I've got a right to get converted into equity shareholders, okay, so what type of shares am I carrying? I'll be carrying convertible preference shares, okay. So what about non-convertible preference shares? Exactly opposite of it. So when it comes to non-convertible preference shares, these shares cannot be transferred or cannot be converted into equity, okay. So these shares cannot be converted into equity. Clear? They'll not be having the option of getting these particular shares converted into equity, as simple as that. Clear? Hope you guys understood this. Okay, so let's have a look at the next type of share. So based on the nature of dividend, okay, so we've got fixed rate dividend and increasing rate dividend. Okay, so what is this fixed rate preference share and increasing rate preference share? So when it comes to fixed rate, as the very name suggests, okay, so they'll be entitled to get some fixed amount of dividend irrespective of profit what I make. Okay, if the company is making, now let's say fixed dividend preference share, okay, 10% preference share. You guys would have heard about this, right? Any preference share will be prefixed by some percentage. Now what does that percentage represent? That percentage will be representing the dividend which we are supposed to pay. Okay, 10% preference shares, 12% preference shares, 15% preference shares. Okay, so these rates are nothing but the rate of dividend which the company is supposed to pay to these particular preference shareholders. Clear? Now when it comes to fixed dividend preference share or fixed rate preference shares, they'll be getting fixed rate of dividend irrespective of the profit which is being made by the company. Okay, now what about increasing rate dividend? Now when it comes to increasing rate dividend, the dividend which they will be receiving in the subsequent year will always be greater than the dividend which is being received in the current year. Now current year, if I have already paid 10% dividend, next year I cannot pay 9% or 7%. The dividend which I will be paying in the next year should always be higher than the dividend which was paid in the current year. Okay, so look at this. So if you guys just have a look at this particular term, look at this fixed rate versus increasing rate preference share. In case of fixed rate preference shares, what happened? The rate of dividend remains fixed throughout the term. Okay, so whatever is the tenure of redemption, this particular rate of dividend is not going to change. It is constant throughout. Okay, so however, in case of increasing rate preference shares, the dividend rate increases after certain period of time. Okay, so basically till certain period of time I'll be paying some rate of dividend. After that, the dividend amount will start increasing. Clear? So I'll just write this. Fixed rate preference share. Now what happens in case of fixed rate preference shares? So the rate of dividend shall remain same throughout the tenure. Okay, so whatever is the tenure of redemption, okay, so initially the company would have decided that these particular preference shares will be redeemable after 20 years. Okay, so till this particular tenure of 20 years, the rate of dividend, is it going to change? No, it's going to remain same. Then when it comes to the next thing, okay, so increasing rate dividend. Okay, let us understand what is this increasing rate dividend or increasing rate preference share. So when it comes to increasing rate preference shares, okay, so these shareholders shall receive the dividend at constant rate for some time and at an increasing rate thereon or therefrom. Clear? For certain period the company will be paying some fixed amount of dividend, and afterwards, okay, the dividend will be increased. Okay, now let us say if I'm paying 10% of dividend initially for 3 years, after that, okay, it cannot decrease, okay, it has to increase. Now let's say fourth year I pay 11%, fifth year 11.5%, sixth year 12%, seventh year 12.2%, it will start increasing. Clear? So based upon the growth of the company, even the dividends start increasing. Okay, so that is what is this increasing rate preference shares. Okay, so then based upon accumulation of dividend, okay, so based on accumulation of the dividend, we have got cumulative and non-cumulative. Okay, so this is important. Let us just understand the meaning of this particular term, cumulative preference share and non-cumulative preference share. Now what does this term mean? What do you understand by this term, cumulative? You guys would have heard about this term, right? Accumulation. Okay, so what is accumulation? It is nothing but collection, right? Correct? So what is this dividend first of all? Dividend is nothing but the return what we pay to the shareholders. Okay, so the shareholders would have contributed their amount to the company, right? Don't you think it is company's obligation to repay something in return? Correct? So dividend is nothing but the share in the profit which is being paid to the shareholders. Okay, so whenever the company is making some profit, okay, so obviously the owners will get a share in it. Okay, so the owners will be entitled to get a share in this particular profit. That share is what is called as dividend. Clear? So dividend is nothing but the return which is paid by the company to the shareholders. Okay, now let us say, okay, so in the first year the company, let's say it got incorporated in the year 2010. Okay, so let me just write it over here. Okay, so let us say the company got incorporated in the year 2010. Okay, so 2010 is the year in which the company got incorporated. Just a second. Okay, so let's say the company got incorporated in the year 2010. Okay, so let me just write the financial result over here. Okay, so financial results of each year. Okay, so let's say 2010, 2011, 2012, 2013 and 2014. Okay, so I'm basically showing you the figures for 5 years. Clear? Okay, so first year, okay, very tough competition. The company could not make any profit. The company suffered a loss of, let's say, 2 lakh rupees. 2 lakh rupees of loss. Okay, so second year again the same thing continued, but this time the loss was little less. Okay, so let's say 1.8 lakh rupees of loss. Okay, now third year the company was able to make a profit, okay, of, let's say, to the extent of 1.5 lakh. Okay, so 1.5 lakh of profit, and then 2.8 lakh rupees of profit, and then finally when it comes to the fifth year, okay, so it was able to scale up to 4 lakh rupees. Clear? So these are the results of the company. Now understand this carefully. So when it comes to preference shareholders, don't you think we'll be paying them return called as dividend? Correct? So we need to be paying them some return called as dividend. Now in the first year, you already understood what is dividend, right? So what is dividend? It is nothing but a share in the profit which is being given to the shareholders. Okay, a small portion of the profit distributed to the shareholders, that is what is called as dividend. In the first year, if you see, I made a loss. Okay, I made a loss of how much? I made a loss of 2 lakh rupees. Will I be able to distribute, okay, any dividend to the shareholders? Now let us say I've got 10% preference share capital. Okay, and now let us say that is worth rupees 1 lakh. Okay, so this is the preference share capital. Okay, so 10% preference share capital of 1 lakh. So how much would be the preferential dividend which I need to pay? What would be the preferential dividend? 1 lakh. On this 1 lakh I need to be paying 10% of dividend. Okay, so that would be close to 10,000 rupees. Okay, so 10,000 rupees of dividend I need to pay. Okay, so 1 second, I don't think this is visible to you guys. Yeah, now I think it is visible. Now look at this, 10,000 rupees of dividend I need to pay. First year, will I be able to make any payment of dividend? No. Okay, why? Because I suffered loss, I'll not be able to pay any dividend. Second year, will I be able to pay the dividend? No, because second year again it was loss, I'll not be able to pay any dividend. Now third year, okay, look at this, third year I made a profit of how much? I made a profit of 1.5 lakh rupees. Okay, now if at all it is cumulative preference share, understand this carefully, just pay attention. If at all it is cumulative preference share, here the shareholder, okay, so they'll be receiving the dividend of 10,000 rupees for the current year. Okay, so this there's no doubt, because the company made profit of 1.5 lakh, they're entitled to receive a dividend of 10,000 rupees. Now, if at all the type of dividend is cumulative, or if at all the type of shareholders are cumulative preference shareholders, along with this 10 lakh rupees of current year dividend, they'll also be entitled to receive the dividend for the last 2 years. Okay, so last 2 years dividend will also get accumulated over here. Are you understanding this? Okay, so these 2 years, okay, the company did not pay any dividend to the shareholders. The reason being very simple: the company did not make enough profit, okay, or the company literally made loss, okay, they were not able to pay any dividend. But in case of cumulative preference shareholders, whenever the company makes profit, it is not only the year with respect to the profit which they will be entitled to receive the dividend, but also the past year's dividend, okay, wherein the company suffered loss, even that will get accumulated. Okay, so here, so 2 years, okay, so 2 years dividend, if you see, how much would it be? That would be 20,000. Okay, so these 2 years I'm talking about these 2 years in which the company did not pay any dividend. Why? Because the company was going through loss. If at all it is like cumulative preference shareholders, it is not only this particular 10,000 rupees relating to current year in which the company made profit, the shareholders will also be entitled to receive the dividend pertaining to those years in which the company suffered loss. Okay, so only thing is they'll not be receiving in that particular year itself. So these 2 years the company made loss, right? 2010 and 11, sorry, 2010 and 11, if you see, the company made loss. So I did not pay any dividend to this particular shareholders. But when the company is making sufficient amount of profit, it is not only the current year profit which they will be receiving, but along with this current year profit, they'll also be entitled to receive the share of dividend relating to those years in which the company suffered loss. So what would be the total dividend which I'll be paying? If at all it is cumulative preference shareholders, here in the year 2012, I'll be paying a total dividend of 20,000 plus this particular 10,000, that is 30,000 rupees. Is this clear? Hope you guys understood this. So here this last 2 years dividend will get accumulated, okay, and totally I'll be paying 30,000 rupees. And from these 2 years, okay, it is already accumulated and paid. So these 2 years I'll be paying 10,000 and 10,000. Now if at all, if it was like non-cumulative preference shares, okay, so I'll not be having any right with respect to these dividend relating to the year in which the company made loss. Okay, so I'll not be receiving any dividend with respect to the year 2010 and 11, nor will I be getting any share. Okay, I'll not be getting this particular right of accumulating these particular dividend relating to the year of loss. Okay, so I'll just be receiving 10,000 rupees in the year 2012, 10,000 in the year 2013, and 10,000 in the year 2014 if it is non-cumulative. If it is cumulative, how much will I be receiving? I'll be receiving 30,000 rupees in the year 2012, 10,000 for the current year, and 20,000 relating to the past 2 years in which the company suffered loss. Hope you guys understood this. Is this clear? Okay, so the same thing I'll be writing over here in the notes. Okay, so let me just write these 2 points. So these shareholders will be having a right to get the accumulated dividend related to the year in which the company suffered loss. Clear? So these particular cumulative shareholders, they'll basically be carrying a right, okay, to get a share in that particular dividend, okay, pertaining to those years in which the company suffered loss. Okay, so let me just give you an example, or let me just tell you this, or take the same example. Okay, so here okay, so let's say here the company made a loss of 2 lakh, here the company made a loss of 1 lakh 50, then the company made a loss of, sorry, profit of 1 lakh 20,000, then 2 lakh 40,000, or let's say 2 lakh 10, Okay, now let me just explain this. So we are having 10% preference share capital, which is, let's say, 1 lakh. So how much would be the dividend which we need to pay? So preferential dividend shall be equivalent to 1 lakh into 10%, that would be 10,000. Okay, so 10,000 is the amount which I need to pay as dividend. Okay, just a moment. Yeah, so 10,000 is the amount which I need to pay as dividend. Okay, so in the year 2018 and 19, so basically in the year 2018 and 19, the company did not pay any dividend. As it suffered loss. Okay, so in the year 2020, okay, that is 2020, in the year 2020, the cumulative preference shareholders shall be entitled to receive the current year dividend of rupees 10,000 and also the dividend related to the past 2 years for which the company suffered loss. Now understand this carefully. So the dividend relating to these 2 years will get accumulated. Okay, so will get accumulated. So basically when the company made sufficient amount of profit in the year 2020, it is not only the dividend pertaining to this year which they will be receiving, along with the dividend pertaining to 2020, they will also be having the right to receive this particular dividend pertaining to past year in which the company suffered loss. Clear? So in case of cumulative preference shares, what will happen is the shareholders will not be receiving any dividend whenever the company goes through loss, okay, or whenever the company suffers loss. 2018, the company suffered loss, no dividend will be received by the preference shareholders. 2019, the company suffered loss, no dividend will be received by the preference shareholders. Now what will happen? These dividends will just keep on getting accumulated, okay, and the moment the company makes profit, okay, so along with the current year dividend with respect to the year in which the company made profit, this accumulated dividend also will get received by the preference shareholders. Okay, so in the year 2020, the cumulative preference shareholders shall be entitled to receive the current year dividend of 10,000 rupees and also the dividend relating to the past 2 years for which the company suffered loss. Okay, so the total dividend received shall be 30,000 rupees. Hope you guys understood this. 10,000 rupees of dividend for the current year, that is 2020, that is the year for which the company made profit, and 20,000 rupees of dividend, okay, will get accumulated for this particular 10,000. Now what does this 20,000 rupees represent? This is nothing but the dividend relating to those 2 years in which the company suffered loss. Okay, in the year in which the company suffered loss, obviously they won't be having the funds, they'll not be paying anything. But the moment the company makes profit or earns good amount of profit, this dividend relating to the year of loss will get accumulated for the current year dividend and total dividend will be paid. Hope you guys understood this. Is this clear? Okay, so in case of non-cumulative preference shares, the shareholders shall be receiving only 10,000 rupees as dividend in the year 2020. In other words, non-cumulative preference shares or preference shareholders shall not be having right to receive the accumulated dividend. Relating to those years in which the company suffered loss. Clear? So these particular non-cumulative shareholders will not be receiving, okay, so the dividend pertaining to the year in which the company suffered loss. Okay, simple thing. So non-cumulative preference shareholders, if you see, they would have received only 10,000 rupees in the year 2020, 10,000 in the year 2021, 10,000 rupees in the year 2022. Okay, so 2022 also they would have received only 10,000. If at all it is cumulative preference share, here nothing would have been received, but in the year 2020, along with the current year dividend of 10,000, they would have received 20,000 rupees relating to the past year dividend also. So totally they would have received 30,000 dividend over here, 10,000 over here and 10,000 over here. Hope you guys understood this. Clear about cumulative preference shares? Non-cumulative preference shares. Okay, so these are nothing but the shares other than cumulative preference shares. Clear? So in simple terms, it would be like this. In case of cumulative preference shares, the shareholders, okay, so whenever the company is making profit, it is not only the dividend relating to the current year which they will be entitled to receive, but along with this, the shareholders will also be entitled to receive the dividend pertaining to past year in which the company suffered loss. Is this clear? Okay, but what happens in case of non-cumulative preference shares? Non-cumulative preference shareholders will be receiving dividend only pertaining to the year in which the company is making profit. They will not be having any right to receive the dividend pertaining to those past year in which the company suffered loss. Clear? Okay, so let's move on to this next type of preference shares. Okay, this is the last type. So participative preference shares and non-participative preference shares. Okay. Now majority of the students would go wrong over here. Okay, so whenever they see participating preference shares, okay, how they would interpret is, these are the shareholders who will be participating in the affairs of the company or management of the company. No, shareholders cannot take active part in the management of affairs of the company. No, this is taken care by whom? This is taken care by a separate body called as board of directors. Clear? Shareholders cannot take active part, okay, in the management of affairs of the company. Now majority of the people would interpret in this way, which is not right. Okay, let me tell you what is this participating preference shares and what is this non-participating preference shares. Now whenever I want to repay any amount, now let us say the company is going under liquidation. Okay, whom do you think will I be paying first? Will I be making the payment to the equity shareholders first and then to the preference shareholders, or should I be paying the amount to the preference shareholders first and then to the equity shareholders? Yes, as the very name suggests, remember the meaning of preference shares. So these are the shareholders which will be carrying preferential right with respect to payment of dividend and repayment of capital. Okay, so when it comes to preference shareholders, I'll be giving them the priority, okay, with respect to payment of dividend and repayment of capital. Now look at this. When it comes to participative preference shares, what does it mean? Even after making the payment to the equity shareholders, if there is still some surplus profit which is left over, okay, so these shareholders will be having a right to get a share in it. Okay, I would have already paid this particular preference dividend, okay, and then whatever is the amount which I was entitled to pay to the equity shareholders, I've already paid. In spite of making the payment to the equity shareholders, there is still some surplus amount which is left over. Okay, so these participative preference shareholders, what will happen? They'll be getting a right to get a share in this particular surplus amount which is left over after making the payment to the equity shareholders. Clear? So when it comes to non-participative preference shareholders, what will happen? So these people will not be getting any share in the surplus which is left over after making payment of equity dividend. Okay, so let me just put it down in this way. So the next type of preference share is participating preference shares and non-participating preference shares. Now don't interpret in this way. It doesn't mean that participating preference share will be participating in the management of affairs of the business. No. Okay. So these shareholders shall have a right to get a share in the surplus profit which is left over after paying the equity dividend. Clear? So after making the payment to the equity shareholders, if there is still some surplus profit which is left over, okay, and these people will be getting a right in it, okay, so that is what is called as participating preference shares, okay. So then the last thing is non-participating preference shares, okay. So let us understand the meaning of this particular term. These are the shareholders who will not be having any right to participate in the surplus profit left over after payment of equity dividend. See, to the equity shareholders will be paying the amount at the end, right? Okay, so even after making the payment of equity dividend, if there is still some surplus amount, okay, which is left over, okay, and preference shareholders are getting a right to get a share from that, those people will be treated as what? Those people will be treated as participating preference shareholders. Clear? So if the preference shareholders are not getting a right to participate in this particular surplus profit which is left over after payment of equity dividend, okay, so those people will be treated as what? Those people will be treated as non-participating preference shareholders. Hope you guys understood this. Is this clear? Yes? Okay. So with this we complete this particular aspect, okay. So that is the types of shareholders, okay. So basically two types, equity shares and preference shares. So when it comes to preference shares, okay, so we have got 10 varieties which you have already discussed, okay, like redeemable preference shares, non-redeemable preference shares, okay. So we have got like cumulative preference shares, non-cumulative preference shares, okay, so convertible preference shares, non-convertible preference shares, participating preference shares, non-participating preference shares. Clear? Okay, just a second. Clear? So these are different types of the preference shares, okay. So let's have a look at the next thing. Share capital of the company. Now what is the share capital of the company? Okay, this is nothing but the total amount which is contributed, okay, so towards the capital. So the total money which is raised from the public, that is what is called as share capital. Clear? So shares, you guys understood, it is nothing but the smaller denomination of the total capital, okay. So when I say share capital, we are representing the total amount, okay. So the total amount which belongs to the owners, okay, that is what is called as share capital. Clear? Now when it comes to types of share capital, okay, just remember the meaning, okay. So they'll not be asking any question from this, but you should be knowing what exactly is authorized share capital, what is issued share capital, okay. So what is paid up share capital, what is called up capital, what is subscribed capital, all these terms you guys should be having knowledge of, okay. So let's have a look at this. So when it comes to different types of share capital, look at this. The first type of share capital is authorized share capital, okay. So what is this authorized share capital? This is nothing but the maximum amount, okay. This is nothing but the maximum amount which the company is authorized to raise, okay. So company has got authority, okay, to issue only to the extent of this much of share capital, okay. So the company can raise the funds maximum to the extent of this much. So as the very name suggests, authorized share capital, okay. So they're talking about some authority, okay. So this is the maximum capital which the company can raise, okay. Look at this. It is the amount of share capital that a company is permitted to issue, okay. At no point of time the company can issue more than what it is authorized, okay. So that is why it is called as authorized share capital, okay. So what is authorized share capital? This is nothing but the maximum shares which the company has got authority to issue. Okay, at no point of time the company can issue more than this authorized number of shares. Okay, so it is the amount of shares, okay, or capital that the company is permitted to issue. Okay, so it is mentioned in the capital clause of memorandum of association. Okay, normally we'll be calling it as MOA. So when it comes to MOA, there will be different clauses. Okay, so like name clause, object clause. Okay, so one of the clause would be like capital clause. Okay, so in case of capital clause, they would have mentioned, okay, what exactly is the maximum amount which the company can issue. Okay, so these are the maximum number of shares which the company has got authority to issue. Okay, so fine, look at this. Now let me just explain it over here. Okay, so let us say the company's authorized share capital is 5 lakh shares of rupees 10 each. Okay, so 5 lakh shares of rupees 10 each. So can the company issue more than this 5 lakh? Okay, now let us say 10th February 2022, company issued 4 lakh shares. Okay, so the company has already issued this 4 lakh shares. Now can the company issue, okay, so the remaining 1 lakh rupees? Okay, so subsequently whenever the company wants to raise the funds, okay, so they can still issue this 1 lakh shares. But whenever they are going for further issue, okay, can they issue more than 1 lakh shares? No, that is not possible. Clear? So this is the maximum number of shares which the company can issue. Okay, so in case of further issue, the maximum shares which the company can issue. Did you understand this? Clear? So out of this 5 lakh shares, if the company has already issued 4 lakh shares, okay, so it can subsequently issue only to the extent of this particular 1 lakh and not more than that. Okay, at no point of time the issued share capital should be exceeding this particular authorized share. Authorized share is the maximum number of shares, okay, which the company has got authority to issue. Okay, so the company cannot issue more than what it is authorized. Okay, so here the maximum number of shares which the company can issue is how much? It is 5 lakh shares. At no point of time the company can issue more than this 5 lakh shares. Hope you guys understood this. Is this clear? Clear about this example? Out of this 5 lakh shares, if the company has already issued 4 lakh shares on 10th February 2022, then subsequently whenever the company wants to raise additional fund, okay, how much is the maximum number of shares which they can issue? They can issue only to this extent. Okay, that is to the extent of this particular 1 lakh. The reason being very simple. Total authorized share capital is 5 lakh. Out of 5 lakh you have already issued 4 lakh. Only to the extent of the balance 1 lakh is what you can subsequently issue. Okay, not more than that. Clear? Hope you guys understood this. Clear about authorized share capital? This is nothing but the maximum shares which the company has got authority to issue. Okay, so company cannot issue more than what it is authorized. Okay, so then let's talk about issued share capital. Okay, so what is the issued share capital? It represents, okay, so that particular portion of authorized share capital which is actually offered for the public, okay, for subscription. Look at this. Issued share capital is nothing but that particular portion of authorized share capital which has been offered by the public for subscription or offered to the public for subscription. In this particular example, if you guys go through, look at this. How much is the total authorized share capital? 5 lakh rupees would be the authorized share capital. Out of this 5 lakh, how many shares did I actually issue? So initially I issued this 4 lakh shares. So this 4 lakh shares will be called as what? This would be called as issued shares. Okay, and if the price of one share is how much? 10 rupees. So 4 lakh shares into 10, that is 40 lakh rupees would be what? 40 lakh rupees would be my issued share capital. Okay, so I'll just write it in this way. Types of share capital. First thing is authorized share capital. not much important from examination perspective, so I'll just briefly write down the meaning over here. If you just refer this much, more than sufficient. Okay, so first thing is authorized share capital. What is this authorized share capital? This is the maximum shares which the company can issue. Okay, so this is as good as a kind of maximum limit. Okay, so there's an upper limit over here. Okay, so which will be prescribed in the memorandum. Okay, so while framing this particular or while drafting this particular memorandum of association, in one of the clause, that is capital clause, they would have mentioned, okay, this is the maximum fund which will be raising from public. Okay, so this is the maximum shares which the company can issue. Okay, so at no point of time the issued shares, or you guys can write it in this way, issued shares can never exceed the authorized shares. Okay, or in other words, the maximum shares which the company can issue should not exceed the authorized number of shares. Okay, so this is the maximum number of shares, okay, so which can be issued by the company. Clear? At no point of time the issued share capital can exceed the authorized share capital. Simple. Now let's talk about this issued share capital. It refers to that portion of authorized share capital which is issued to the public for subscription. Okay, so let me just give you the same example. Okay, so if the total authorized share capital of the company, let's say it is 50 lakh rupees, okay, 5 lakh shares of rupees 10 each. Out of this 5 lakh rupees, if only 4 lakh shares have been issued, so 4 lakh shares will be called as what? This would be called as issued share capital. Okay, so let me just write this. So let's say ABC Limited authorized share capital, okay, let's say it is 5 lakh shares of rupees 10 each, so which would be 50 lakhs. Okay, so 50 lakh is the authorized share capital. Okay, so out of this, let's say the company has issued 4 lakh shares on 10 February 2022. Okay, so 40 lakhs shall be the issued share capital. Okay, so this particular 40 lakh rupees shall be what? It shall be considered as issued share capital. Clear? Now, subsequently, if the company wants to raise additional fund, okay, so in case the company wants to raise additional fund, okay, then the maximum shares which it can issue shall be how much? How much would be the maximum shares which it can issue? Out of 5 lakh shares, 4 lakh shares is already been issued. Okay, so the maximum shares which it can issue shall be how much? It shall be 1 lakh shares. Hope you guys understood this. Clear about the meaning of the term authorized share capital? So what is authorized share capital? This is the maximum shares which the company has got authority to issue. Okay, at no point of time the company can issue more than what it is authorized to issue. Clear? Okay. So let's move on to the next thing, subscribed share capital. Now what is the subscribed share capital? So why do you think the company is issuing these shares to the public? So just because the public wants to subscribe. Now let us say the company issued 4 lakh shares. Okay, it's not necessary that entire 4 lakh shares has to be subscribed by the public. There might be situation of oversubscription, full subscription, or even under subscription for that matter. Okay, so company is issuing 4 lakh shares, exactly 4 lakh shares were subscribed by the public. This will be called as what? This will be called as full subscription. I issued 4 lakh shares, public came and subscribed exactly 4 lakh shares. This is full subscription. Now I am issuing 4 lakh shares, the company is issuing 4 lakh shares, public subscribed only to the extent of 3 lakh shares. This will be called as what? This will be called as under subscription. Okay, so public are subscribing for lesser than what is issued. Okay, I am issuing 4 lakh shares, public are willing to subscribe only to the extent of 3 lakh shares. Okay, so this would be treated as what? This would be treated as under subscription. I am issuing 4 lakh shares, but public are willing to subscribe more than this. Okay, public are ready to subscribe for 5 lakh shares. Okay, so this would be treated as what? This scenario will be treated as over subscription. Clear? So all these things, in case of oversubscription, what are we supposed to do? How are we going to deal with this particular situation? Okay, all these things will be dealt in this particular chapter. Okay, so why am I telling you this? Look at this next thing, subscribed share capital. What does this represent? This is nothing but that portion of issued share capital which is actually being subscribed by the public. Okay, so let me just write it over here. Subscribed share capital. Okay, so what is the subscribed share capital? It refers to the value, okay, for which public is subscribing. So if the company is issuing 4 lakh worth of shares or 4 lakh number of shares, public, okay, so if they are subscribing, let's say for 3,80,000, that 3,80,000 would be subscribed shares. Okay, so it refers to that portion of issued share capital which is actually subscribed by the public. Clear? So it refers to that particular portion of amount, okay, so which is issued by the company and which is actually subscribed by the public. Okay, okay, so let's say, okay, if I just continue with this particular example, okay, the same example. So let us say the company issued 4 lakh shares on 10th February. Okay, 40 lakh shall be the issued share capital. So let us say public subscribed only 39 lakh shares. Then subscribed share capital shall be, sorry, it is 3.9, or I'll just write it in this way. So out of 4 lakh, let's say 3.2 lakh shares. Okay, so then 32 lakh shall be the subscribed share capital. Clear? So the company issued 4 lakh shares. Out of this 4 lakh shares, if only to the extent of 3.2 lakh shares, okay, are subscribed by the public, then this 32 lakh rupees will be treated as what? This would be treated as subscribed share capital. Clear? So the company is issuing the shares. For what purpose do you think the company is issuing the shares? Just for the public to subscribe them. Okay, so out of this 4 lakh shares, there might be various possibilities. Okay, public came forward and subscribed for the entire 4 lakh shares. Okay, 40 lakh rupees would be the subscribed share capital. So out of this 4 lakh shares which the company issued, the public are subscribing only to the extent of 3.2 lakh shares. Okay, so 32 lakh rupees will be the subscribed share capital. Did you guys understand? Authorized share capital, this is the maximum number of shares which the company can issue. Issued share capital is nothing but the actual number of shares which the company issued to the public for subscription. And what about this subscribed share capital? This is that portion of issued capital which is purchased or subscribed by the public. Clear? Okay. So then we have got called up capital. Okay, so what is this called up capital and paid up capital? So these two are interlinked. Okay, so the company will be making a reminder to the shareholders, okay, so that this is the amount which is due. So normally what the company will be doing is they will be collecting the amount in installments. Okay, so normally those installments will be treated as what? You got application stage, allotment stage and call money stage. Okay, so application, initially only the company will be receiving. Okay, but when it comes to allotment and call money, the company will be making a reminder, okay, to each and every shareholder that this is the amount which is due from you. Okay, kindly make the payment within so and so date. Okay, so this particular thing will be called as what? It will be called as called up capital. Okay, so company making a reminder to the shareholders. Okay, so that is called up capital. Now again, it's not mandatory that all the shareholders who are reminded will be making the payment on time. Okay, there might be few people who will not be making the payment. Now let us say out of 10 lakh shares, okay, so company made a reminder to the entire 10 lakh shareholders. Okay, so out of this particular 10 lakh shareholders, 9 lakh 80,000 shareholders paid the amount. Okay, so 10 lakh will be the called up shares. Okay, so because the company made a call to everyone, okay, entire 10 lakh shareholders, out of this 10 lakh shareholders, only to the extent of 9.8 lakh shareholders paid the amount. That would be called as what? That would be called as paid up capital. Called up capital would be what? 10 lakh shares into 10. Okay, paid up capital will be what? Only to the extent of 9.8 lakh, okay, turned out to pay the amount. That would be treated as paid up capital. Clear? Okay, so the next two thing will be called up capital and paid up capital. Okay, so look at this called up capital. It is that part of subscribed capital which has been called up by the company for payment. The company will be making a reminder to the shareholder that this is the amount which is due from you. Okay, so it refers to that portion of subscribed capital which is called up or reminded by the company. Okay, so company will be making a reminder, right, that this is the amount which is due from you. Okay, so it represents that portion of the amount which is called up or reminded by the company. Okay, so then comes paid up capital. So what is this paid up capital? So paid up capital is nothing but that portion of this particular called up capital which is actually being paid. Now if I am making a reminder to the shareholders, it is not mandatory that all the shareholders will be making the payment. I reminded the entire 10 lakh shareholders to make the payment. Out of this 10 lakh shareholders, only 9.8 lakh shareholders turned out to pay the amount. Okay, so only this 9.8 lakh shares, okay, will be treated as paid up. Clear? So look at the meaning of this particular term. So that part of called up capital which is offered and is actually paid by the members. Okay, so it refers to that portion of the called up capital which is actually paid. Okay, so I made a reminder to the entire 10 lakh shareholders. Out of this 10 lakh shareholders, only 9.8 lakh shareholders paid the amount. Okay, so look at this. So let's say 10 lakh shares. Okay, so I sent the reminder. Okay, so this 10 lakh will be called as what? This will be called as called up capital. Okay, because I have made a reminder to the entire 10 lakh shareholders. Okay, now out of this 10 lakh shareholders, let us say only 9.8 lakh shareholders paid. Okay, I made a reminder to the entire 10 lakh shareholders, so this would be treated as my called up capital. But out of this 10 lakh, only 9.8 lakh, okay, so only to the extent of 9.8 lakh shareholders, they paid the amount. Okay, so this would be treated as what? This would be treated up as my paid up capital. Okay, so I have made a reminder to the entire 10 lakh shareholders, that would be treated as my paid up capital. But out of this 10 lakh shareholders, only 9.8 lakh shareholders turned out to pay the amount. Okay, so this 9.8 lakh shares will be treated as paid up. Simple. Okay, So let's have a look at this last part. Okay, so not much important, but let's just cover this. Reserved capital. Okay, so what is this reserved capital? It is the portion of uncalled capital. Always remember, this is uncalled capital of the company that is called up for payment only in the event of liquidation. I'm just keeping it as reserve. Okay, I'm not reminding the shareholders to make the payment immediately. So what I do is I'll just keep it as reserve. Okay, and I'll be asking these particular people to make the payment, or I'll be reminding these people to make the payment only in the event of liquidation or winding up. Okay, because that is the time wherein I'll be requiring the funds. Okay, so what I'll be doing is I'll be keeping this as reserve. Okay, that is why it is called as reserved capital. Okay, so this is uncalled. First thing to remember is it is uncalled capital. Okay, so it is uncalled capital, and the remainder will be made. Okay, remainder will be made only in the event of liquidation or winding up. Okay, so only in the event of liquidation or winding up, the remainder will be made and the amount will be paid. Hope you guys understood this. Clear? Okay, now look at this, how exactly these particular capital will appear in your financial statement. Okay, so look at this, reporting of share capital in the balance sheet. Okay, so when it comes to liability side, it would appear like this, share capital. Look at this, authorized share capital. Okay, this is the maximum number of shares which can be issued by a company. Okay, so no company can issue more than its authorized share capital. After authorized, what comes? Issued share capital. Okay, so this is the maximum shares which can be issued. The company actually issued these many shares. Out of these issued shares, how many shares are subscribed? Look at the third one, issued and subscribed. Okay, so then out of these subscribed shares, the company will be making a reminder, okay, to the shareholders. Okay, that would be treated as called up share capital. And finally, okay, so those particular people who did not make the payment, that would be treated as what? That would be treated as arrears amount. Clear? So in this example, I had made a reminder to the entire 10 lakh shareholders. Out of this 10 lakh shareholders, 9.8 lakh shareholders paid. So how much would be the arrears? It would be arrears from the remaining 0.2 lakh or 20,000 shareholders. Okay, so that would be treated as what? That would be treated as calls in arrears. Okay, finally I'll be able to get the paid up capital. Clear? Hope you guys understood this. Okay, clear? So this is pertaining to share capital. Okay, so this part not important. Okay, so let's talk about various types of share issue. Again, not relevant. So what is relevant is the entries what I'll be passing, the journal entries what I'll be passing with respect to issue of these shares. Okay, so let's look into this. So various types of share issue. One is public issue, another thing is private placement, right issue, bonus shares, and offer for sale. Let me briefly tell you the meaning of these particular terms. Okay, so what is public issue? If I'm issuing the shares to the public, okay, so that will be called as public issue. Okay, so I want to raise the funds from the public. So if I want to raise the funds from the public, what am I supposed to do? Don't you think I need to be offering them something? So if I'm offering the shares to the public for subscription, it would be treated as what? It would be treated as public issue. Look at the meaning. Here the shares are offered directly to the investors for subscription. Okay, accordingly any person may become the shareholder of the company. Okay, if I've got the money and if I apply for a particular company's shares, okay, or if I'm subscribing for any particular company share, I'll be the shareholder of that particular company. Okay, or I'll be becoming that particular company shareholder. Okay, so when it comes to private placement, okay, so look at this, what happens in case of private placement? I'm not issuing the shares to public in general. Okay, look at this, here the shares are issued by the company to smaller number. Okay, so look at this, issued by the company to smaller number of selected investors. Okay, so preferably the financial institutions. Okay, so financial institutions like banks, okay, insurance company, the mutual fund companies. Okay, so these things will be treated as what? This would be treated as private placement. Clear? It's not that anybody can become the shareholder in this case. Okay, so when it comes to private placement, the company is offering its shares only to the institutional investors. Okay, so these institutional investors can be either banking companies, insurance company, mutual fund companies, or any other thing for that matter. Okay, so what these institutional investors will be doing is they'll be purchasing this particular company's shares. Clear? So they'll be purchasing this particular company shares. It is not open for public to subscribe for these shares. Okay, when it comes to private placement, look at the meaning or look at the term private placement. Okay, first thing is public issue. I'm issuing the shares to the public in general. When it comes to private placement, I'm not issuing the shares to public in general. Okay, so I'm giving this particular offer of subscription to institutional investors. Clear? Then when it comes to right issue, what is this right issue? Whenever the company is planning to raise additional amount of capital, okay, what they'll be doing is they'll be giving this offer initially to the existing shareholders. Now let us say out of that 5 lakh rupees of authorized share capital, the company has already issued 4 lakh. So the company has still got power to issue this remaining 1 lakh rupees or 1 lakh shares, okay, to the public. Now when they are issuing this 1 lakh shares, what is their objective? Their objective is to raise some additional funds. Okay, now when they want to raise additional fund, what they'll be doing is they'll be issuing something called as right shares. Okay, what is this right shares? I'll be giving the offer to the initial existing shareholders. So instead of giving the offer to the new public, okay, what I'll be doing is I'll just be communicating to the existing shareholders that the company is planning to raise some additional funds. Okay, they'll be issuing additional 1 lakh shares. Okay, so if you guys, that is the existing shareholders, if you are interested, you can subscribe for this particular company shares, okay, at some concessional rate. Okay, I'll not be issuing the shares to the existing shareholders at the prevailing market price, rather I'll be giving some kind of concession to them. Clear? So what is right issue? Right issue is nothing but giving an offer, okay, of additional shares which is being issued by the company to the existing shareholders. Okay, so look at this. Here the shares are offered. Okay, so shares are offered to whom? The shares are offered to the existing shareholders of the company. Okay, at what price? At a price which is little lesser than the prevailing market price. Okay, to the existing shareholders I will be giving some kind of concession or discount. So therefore I'll be issuing these right shares to the existing shareholders at little lesser price. Clear? Now what about bonus issue? So bonus issue is nothing but the additional shares which is issued, okay, to the existing shareholders free of cost. Okay, so whenever we say bonus, okay, that is as good as some kind of additional benefit which is given. Okay, so few companies they'll be giving dividend, and few companies along with dividend they'll also be issuing some bonus shares. So what is this bonus shares? It is nothing but some additional shares which is issued to the existing shareholders free of cost. Okay, so here they'll not be receiving any sort of consideration. Okay, so look at this. Here the shares are offered to the existing shareholders of the company without any consideration. This is what is important. When it comes to bonus shares, the company will not be receiving any kind of consideration. Okay, so in case of right issue, what will happen? The company will be giving an offer to the existing shareholders, and from the existing shareholder the company will be receiving some consideration. Okay, so this consideration will normally be lesser than the prevailing market price. But when it comes to bonus shares, okay, so company will be issuing shares to the existing shareholders free of cost. That is, the company will not be collecting any sort of consideration from them. Clear? So let's talk about this last thing, that is offer for sale. Okay, so what is this offer for sale? An offer for sale is a mechanism, okay, that allows promoters, okay, to reduce their holdings. Okay, so here what will happen is promoters will be having certain number of shares. Okay, so certain number of shares will be held by the promoters, certain number of shares will be issued to the public. Now if the promoters do not wish to continue to become the shareholder or to continue being shareholders in this particular company, what they can do is they can give away the shares. Okay, so in what manner they will be selling their shares? It will be treated as offer for sale. Okay, the promoters will be giving certain offer. Okay, so if I'm promoter of a particular company, what I'll be doing is, if I do not wish to be a shareholder in this company, I'll give you an offer. Okay, I'm willing to sell my shares, okay, to the public. So whoever are interested can purchase my shares. Okay, so what you guys will be doing is you guys will be bidding. Okay, so that I bid to purchase the shares at 12 rupees each. Okay, I bid to purchase the shares at 15 rupees each. I bid to purchase the shares at 20 rupees. Okay, an auction would happen. Okay, so whoever is the highest bidder, I would prefer to sell my shares to him. As simple as that. Clear? Now look at this. So what is offer for sale? It is basically a mechanism wherein the promoter will be selling his stakes. Okay, so look at this. Promoter to reduce the holding, okay, of a listed company. Okay, so these shares sold by the promoters are offered for sale directly to the public through bidding process. That is what I mentioned now, right? Correct? So these shares will be sold, okay, by the promoter, okay, by conducting something called as bidding process. So whoever is the person who is having his highest bid, an auction would happen and the highest bidder is the one to whom I'll be willing to sell my shares. Clear? Hope you guys understood this. Clear about all these terminologies? Let me just brief these stuff. So what is public issue? The shares will be offered to the public for subscription. Okay, what is private placement? In case of private placement, the shares will not be open to get subscribed by the public. Okay, so rather I'll be giving offer to only institutional investors. Okay, so institutional investors can be either bank, the mutual fund company, the insurance company, or anything for that matter. Okay, so I'll be giving the offer for subscription only to these people. Okay, the institutional investors. Okay, and then when it comes to right issue, what happens in case of right issue? So in case of right issue, whenever the company is planning to raise additional funds, okay, so these additional funds will be offered to the existing shareholders. Okay, so what I'll be doing is I'll be giving an offer to the existing shareholders. Okay, first. And will the company be receiving some amount from them? Yes, the company will be receiving the consideration from them, but not the prevailing market price. So normally whenever I'm issuing right shares, okay, so the price at which I'm issuing the shares to the existing shareholders will be little lesser than the prevailing market price. Then the bonus share. Now what happens in case of bonus shares? In case of bonus shares, the company will be issuing shares, okay, to the existing shareholders, but only thing is the company will not be receiving any sort of consideration from them. Okay, company will not be receiving any consideration. Bonus shares are issued free of cost. Okay, it is not issued to the public. Always remember, it is issued to the existing shareholders. Whether it is right issue or bonus shares, both these shares, okay, are offered to the existing shareholders. Clear? So lastly, when it comes to offer for sale, okay, so here it is just a kind of mechanism wherein the promoter will be reducing his stakes. Okay, so he'll be selling his shares to any person. Okay, so through conducting an activity called as bidding process. Simple. I hope you guys understood this. Any kind of doubt or any confusion so far? Clear? Okay, so now let's talk about this particular thing. Okay, so issue price of share. Okay, so what is the price at which the company will be issuing? Okay, so issue price. The company can issue shares at par or premium. Okay, so no company is authorized to issue the shares at discount. Okay, so company cannot issue the shares at discount. Okay, company can either issue the shares at par or premium. Okay, it cannot issue the shares at discount. Okay, so look at this. So here if you see, okay, so company can issue the shares at par, premium and discount. Okay, so when it comes to discount, look at this particular note. Relevant provision of Companies Act 2013 in this regard has been discussed later. Okay, so not relevant. Okay, 1 second. Yeah, so look at this. When shares are issued at a price lower than the face value, it is called as discount. Okay, so somewhere later they would have given that the company cannot issue the shares at discount. Okay, so according to the provision of this Companies Act 2013, no company can issue the shares at discount. Earlier, yes, the company had the freedom of issuing the shares at par, premium and discount, but now the company can issue the shares only at par or premium and not at discount. Okay, but let me just tell you the meaning. Okay, so what is par, premium and discount? Okay, so we have got three things. Okay, the company can either issue the shares at par, premium or discount. Clear? So now let us understand what exactly is this par, what is this premium and what is this discount. Okay, so in order to decide whether the company is issuing the shares at par, premium or discount, so we should be comparing two things. Okay, so we should be comparing the face value of the shares as well as the actual issue price. Okay, now what is the face value of the share? Face value of the share is nothing but the share price which is decided initially. Okay, so initially the company would have decided that they will be issuing the shares at so and so price. Okay, so that would be treated as face value. Okay, now if face value is equal to issue price, okay, so FV is nothing but the face value, IP is nothing but the issue price. Okay, if face value of the share is equivalent to issue price, okay, it would be a scenario of par. Okay, so let's say 10 rupees share. okay, I'm issuing at 10 rupees. Okay, it would be treated as what? It would be considered as if the company is issuing the shares at par. Okay, so 10 rupees worth of share I'm issuing it at 10 rupees, that would be treated as par. Okay, so in case of premium, what will happen? What is premium? Premium, is it something less or is it something which is addition? Don't you think premium is something which is always extra? Discount is something which is less. Premium is something which is extra. Okay. Now, in case of premium, let's understand what exactly will happen. Okay. So, 10 rupees worth of share. Okay. Will I be issuing it at greater price or will I be issuing it at lesser price? If I want to call it as premium, obviously I'll be issuing it at greater price. Now, let us say my company share has got demand in the market. Okay. Although face value is 10 rupees. I know even if I give an offer to the public that this particular share will cost you 12 rupees or 15 rupees, okay, just because of higher demand, public would come and subscribe to my shares. Okay, so in that particular situation, what I'll be doing is I'll be issuing the shares at greater than face value. Okay, so in this case, the issue price will be greater than face value. Okay, so the issue price will be greater than face value. Okay, so 10 rupees share. Okay, so let's say 10 rupees share issued at 12. Okay, so this would be treated as premium. Okay, so 2 rupees will be treated as what? 2 rupees will be treated as securities premium. Okay, so the demand for my company share is high. Okay, so what I do in that case is I'll be willing to issue the shares not at face value. I would rather prefer to issue the shares at little higher amount. So such extra amount is what is called as premium. Okay, so normally we'll be calling it as securities premium. So in this case, you will have to remember this: the issue price will be greater than face value. Here the face value will be greater than issue price. Now what will happen in case of discount? There's not much of demand when it comes to my company share. Okay, so even if I issue at face value, nobody is willing to purchase. Very few people are coming forward to purchase my company shares. At that point of time, what I'll be doing is I can issue the shares at discount. Okay, so practically now it is not possible. Just because it is there in the syllabus, I'm just explaining you the meaning of this particular term, discount. Can the company issue the shares at discount? No. Okay, so as per the provision of Companies Act 2013, no company can issue the shares at discount. Okay, so here what would happen is the issue price will be lesser than the face value. Okay, so let's say 10 rupees share issued at 8 rupees. Okay, so this would be treated as a situation of discount. Clear? So what is par? Par is a situation wherein the face value and issue price will remain same. Okay, so 10 rupees share, if I'm issuing it at 10 rupees, that would be treated as par. Okay, so what is premium? 10 rupees share, if I'm issuing it at 12 rupees or 15 rupees, that would be treated as premium. Okay, so I'm issuing the shares at extra price, that is premium. Okay, so what about discount? So I'll be issuing the shares at little lesser price. Okay, so 10 rupees share issued at, let's say 8 rupees, 7 rupees, that would be treated as discount. Okay, so let's just write these points in the notes. So what is a par? So par is the situation wherein the issue price shall be equal to face value. Okay, so example for this would be 10 rupee share issued at 10 rupees only. Okay, so 10 rupees share, if I'm issuing it at 10 rupees, that would be treated as what? That would be treated as par. Okay, so what about premium? So premium is the situation wherein the issue price shall be greater than face value. Okay, now 10 rupees share, if I'm issuing it at 12 rupees, that would be treated as premium. Okay, so 10 rupees share issued at 12 rupees, that would be premium. So in this case, 2 rupees will be treated as what? 2 rupees will be treated as securities premium. Okay, and then one more thing, I'll just write it over here, that would be discount. So what is discount? It is a situation wherein the issue price shall be lesser than the face value. Okay, so example would be 10 rupees share if I'm issuing it at, let's say, 8 rupees. Okay, so 2 rupees will be the discount. Okay, and here I'll also write a note. Okay, so no company can issue the shares at discount. Okay, so company cannot issue the shares at discount. Okay, so no company can issue the shares at discount. It can either issue the shares at par or premium. Okay, so we'll be learning. Okay, so the journal entries. Okay, so what exactly will be the journal entries which will be passing if the company is issuing the shares at par, if the company is issuing the shares at premium. Okay, so no question about discount again. Okay, so discount only in case of sweat equity. Okay, so the company can issue that altogether is a separate concept. Okay, let's not worry about it as of now. Clear about these terminologies? Yes, clear about what is par, what is premium, what is discount? Clear? Okay, okay, so fine. Okay, so let's take a small break. After the break we shall just continue our discussion. Okay, so we'll practically understand what exactly are the journal entries which will be passing at the time of issue of shares. Okay, so let's take a small break, guys. Okay, so hope you guys are clear with this particular concept, like what exactly is par, what is premium, and what is discount. Okay, so what happens in case of par? Yes, so 10 rupees share, if I'm issuing it at 10 rupees, that would be treated as par. Okay, on par. Okay, so what is premium? Premium, always remember, there is something which is extra. Okay, so premium is something which is extra. Now 10 rupees share, if I'm issuing it at 12 rupees, that 2 rupees will be treated as the extra money which I'm receiving. Okay, so that would be treated as premium. Okay, and in case of discount, discount is always something which is less. Okay, so 10 rupees share, if I'm issuing it at 8 rupees, that would be treated as discount. Clear? Okay, and always remember, can the company issue the shares at discount? No. Okay, so the company cannot issue the shares at discount. Then the next thing is, when it comes to public issue, okay, so public issue, if you see, okay, we have got fixed price method and book building method. Okay, so let us understand what exactly is this fixed price method and what is this book building method. So what happens in case of fixed price method? So here shares are issued at predetermined price. Okay, so the price will be predetermined. The public is made to know about this particular price through prospectus and requested to send the application for subscription of the shares. Okay, so what will happen is, the price will be predetermined. Okay, it will not depend upon the market price. Okay, so this particular share price will be predetermined, and it would be mentioned in the prospectus that our company shares will be issued, okay, at this particular amount, 120 rupees, 140 rupees. The amount will be particular and specific. Okay, so public, if any person is interested to purchase the company shares, he can apply. Look at this. Here the shares are issued at a predetermined price. The public is made known about this particular price through prospectus and are requested to send the application for subscription of the shares. Okay, public will be applying for these particular shares. Okay, the total proceeds can be collected either in lump sum or in installment. It's not mandatory that the entire amount has to be obtained in one shot only. Okay, so the amount can be obtained either in lump sum or in installments. Okay, so we'll be talking about the journal entries, what will be passing if the company is receiving this particular amount in installments and all. Clear? Okay, now what about book building method? Okay, so let's talk about this book building method. So clear about this particular fixed price method. What happens in case of fixed price method? The price at which the company will be issuing the shares, okay, will be predetermined. It will be fixed and it will be mentioned in the prospectus. So whoever is interested in purchasing this particular company shares, okay, so he can apply for the same at the predetermined price, whatever it is. Clear? Okay, and when it comes to the amount, it can be received by the company either in one lump sum amount or in installments. Okay, no restriction with respect to that. Let's understand what exactly is this book building method. So here shares are not offered at a predetermined price, exactly opposite. Okay, so here the price is not predetermined, okay, but the final share price is determined after collecting the bids from the investors. Okay, so final share price shall be decided after collecting the bids from the investors, okay, at various prices. Okay, so there will be a bandwidth basically. Okay, so we'll be issuing the share somewhere between 20 rupees to 60 rupees. Okay, so I'll be allowing the public to bid for it. Okay, so few people will be telling that we'll be purchasing at the lowest bid. Okay, so that is, let's say if the price range is somewhere between 20 to 60, few people will be telling we'll be buying the shares at 20. Okay, few people will be telling that we are ready to pay even 40. Okay, so there will be basically a price band. Okay, so a basic range kind of thing. Okay, from 20 to 60. Now look at this. Here shares are not offered at a predetermined price. First point to remember is here. Okay, so that is when it comes to book building method, here the shares will not be issued at a predetermined price. The final share price will be determined after collecting the bids from the investors at various price within the price band. Remember I told you there will be a range. Okay, so people or investors who are bidding, they need to bid within this particular range. In the example what I mentioned, the range was 20 rupees to 60 rupees. Okay, so the price at which the shares are ultimately allotted is called as cutoff price. Okay, so after considering these prices which were bid by the investors, the company will be deciding a cutoff price. Okay, few people are willing to buy that basic price of 20, few people are even ready to pay 40 rupees. Okay, so we'll just decide and we'll just come to a particular point. Okay, so that particular price will be treated as cutoff price. Clear? The proceeds are normally collected on lump sum basis, okay, and accounted accordingly. Okay, so whatever is the proceeds, that is collected on lump sum basis and it is accounted accordingly. Look at this. Here proceeds, okay, so is it collected in installments? No. Okay, so it is collected in lump sum basis. Okay, so the entire amount will be collected in one shot. Okay, there is no option of collecting the amount when it comes to book building method in installments. Okay, so book building method, the amount will be collected in lump sum. Okay, so what about fixed price method? The amount can either be collected in lump sum or even in installments. Okay, now let me just brief these 2 points out. Okay, again. Okay, so when it comes to the issue price, okay, so we have got two methods: fixed price method, book building method. What happens in case of fixed price method? As the very name suggests, okay, always focus on the name, fixed price method. What happens over here? The price is predetermined and it would be mentioned in the prospectus. So whoever is the interested investor who wants to purchase the company share, he will be paying this particular fixed price, okay, which is predetermined already. Clear? And the amount can be collected by the company either in installments or in one shot. Clear? But when it comes to book building method, what will happen? Is the price predetermined? No. Okay, the price is not predetermined. Okay, so it would be decided. Okay, so normally we'll be calling it as cutoff price. The cutoff price will be decided based upon the bids which is made by the investors. Okay, so there will be a price band or price range, okay, within which the investors will be bidding. Okay, based on their response, a cutoff price will be decided and that is the price at which the shares will be issued. And what about the amount? Will it be collected in installments? No. Here the amount will be collected in single shot. Okay, that is in lump sum. Clear? Okay, so stages of collection of issue price. Now whenever the company is collecting the amount in installment, what exactly are the different stages in which they'll be collecting the amount? Okay, so for these stages we'll be understanding the journal entries as well. Okay, so if you just look forward, it's all about journal entries. Okay, so let's just discuss this. So basically three stages: application stage, allotment stage and call money stage. Okay, so let me just explain this and simultaneously let me just prepare the notes for the same. Stages of collection of money at the time of issue of shares. Okay, so basically we have got three stages: application stage, second stage would be allotment stage, and finally it would be call money stage. Okay, now let me just explain what exactly are these three stages. What is application stage, what is allotment stage, and what is this call money stage? Now what happens in case of application stage? If I want to become a shareholder in a particular company, okay, so what I'll be doing is I'll be applying for shares in that particular company. Okay, I apply for the shares. When I'm applying for the shares, obviously I need to pay certain minimal amount. Okay, in order to purchase the application and prospectus, I need to pay some minimal amount. Okay, that is application stage. Okay, so before even becoming shareholder, if I'm just willing to become a shareholder in a particular company, I'll be paying the application money. Okay, so after that, okay, the company will be deciding whether to allot the shares or not. Okay, so depending upon whether it is full subscription, over subscription or under subscription, the company will be deciding. Okay, now will I be paying the entire amount of shares at the time of application? No. Okay, only some minimal amount I'll be paying. Okay, subsequently the company will be deciding. Okay, so company will be deciding whether to actually allot the shares to this particular person or not. Clear? So at that point of time, the company will be requesting me to pay the next installment amount. Okay, so that would be allotment. Clear? And what about call money stage? Call money stage is something like this. So whatever is the leftover amount, okay, which I did not pay. Now let us say out of this 10 rupees share, I have already paid 8 rupees. Okay, so the remaining 2 rupees, the company will be making a reminder. Out of 10, you have already paid 8, 2 rupees is still pending. Kindly make the payment. Okay, so this final amount, the leftover part, that is what is called as call money stage. The company makes a reminder to me and I'll be settling the amount to them. Clear? So this entire situation, guys, you guys can connect it with your PU days. Okay, let me just explain it how. Now let us say after your SSLC examination, that is your 10th examination, what do? Obviously you guys will be looking for college, correct? You will be applying for seats in various colleges, right? Correct? So you guys with your parents, you guys would have visited a lot of colleges. Okay, so you guys would have shortlisted certain colleges and you guys would have applied. You wouldn't have applied only in a single college, right? Okay, so depending upon your percentage, you would have shortlisted the number of colleges and you would have applied. Okay, so let's say you applied in 2-3 colleges. Okay, now when you are applying, don't you think these particular colleges will be selling the applications? They'll be asking, right, whether you want just the application or you want application and the prospectus. Correct? Remember these stuff? Yes. So in the application you will be providing various information, okay, like how much marks was scored in the SSLC. Okay, so basic details about you, okay, like your contact details, your address, your name and other stuff. Okay, so you pay some minimal amount in order to purchase that application. That is application stage. Okay, now after this, don't you think the colleges will be releasing this particular list in the first list? Okay, in the first list, whether your name appears or not, whether you have been allotted a seat in that particular college or not. Okay, depending upon the marks whatever you would have scored. Okay, the college will be deciding whether to allot a seat to you or not. Okay, so that is allotment stage. Okay, and once the seat is allotted and if you are willing to get admitted in that particular college, don't you think you will be paying the fee? Okay, so they'll be reminding. Okay, so the colleges will be reminding, in case you want to apply a seat in our college, kindly make the payment of so and so amount of fee within so and so date. Okay, so that is called up capital. Hope you guys understood this. Clear? So when I'm purchasing, when I'm willing to become a shareholder in a particular company, or if I'm willing to apply for shares in a particular company, I'll be paying some minimal amount, that is application money. Clear? And then once the company allots the shares, it will be asking for some more additional amount, because at the time of application I would have paid only minimal amount. Okay, so the company wants to know whether I'm seriously interested to become a shareholder in that company or not. Okay, so out of 10 rupees application, I would have paid some minimal 2 rupees. Okay, now the company, if they are allotting the shares, okay, they'll be demanding for the remaining amount. Okay, let's say out of 10, 2 I paid towards application. They'll be telling, okay, you pay 6 more rupees now. Okay, we'll be allotting the shares to you. Okay, the remaining 2 rupees you can pay it later on. Clear? So this 6 rupees when I pay, okay, when I'm actually allotted the shares, that would be treated as allotment money. And what about call money? Remember that 2 rupees which I did not pay initially? The company will be making a reminder, okay, that 2 rupees is still pending from you. Okay, so kindly make the payment. So this 2 rupees when I pay, that would be treated as call money. Did you understand this? The company will be making a reminder. Remember called up capital? It's the same thing. Okay, so the company will be making a reminder that so much of amount is due from you. Kindly make the payment. Okay, so that would be treated as called up capital. Now let us talk about the crucial part. Okay, that is the journal entry pertaining to these stages. Okay, now let me tell you what practically happens. Okay, so let me just show it over here. Yeah, So let us say the company issued, okay, so let's say ABC Limited, just a second. One lakh shares of rupees 10 each. Okay, so ABC Limited is issuing 1 lakh shares, okay, at rupees 10 each. Just a second, yeah. Clear? So the company is issuing 1 lakh shares of rupees 10 each. Okay, so now let's assume that 10 rupees share has been issued at 10. Okay, so this would be treated as what? Is it par, premium or discount? It is par. 10 rupees face value of share, if it is issued at 10 rupees, it would be treated as par. Now, if I want to apply, okay, so let us say Mr. A applied for 10,000 shares. Okay, so if I want to apply for 10,000 shares, what I need to do? I need to pay the application money first. Okay, it's not that company will be reminding me. See, for company I'm nobody. Company will not even be knowing who I am. Correct? So if I want to become the shareholder, okay, I need to apply for the shares. Okay, only then company will get to know that so and so person is interested in purchasing so many number of shares. Okay, so first thing is I need to pay some minimal amount and purchase the application. Okay, I need to apply for the shares. If I want to apply, I need to pay some minimal amount and purchase that particular application. Okay, so what I do is, initially if I want to become a shareholder, I need to pay the application money. Once I pay the application money, I would have filled all my details, right? Remember the connection which I gave with your college admission, correct? For the college you will be nobody. Okay, so only when you fill up the application, okay, and you show your interest that you are willing to get a seat in that particular college, only then the college will be considering. Okay, otherwise the college will never know that you are interested in applying a seat to them. They'll not come to your home and give the application, right? You need to visit the college and you need to purchase the application by paying some minimal amount. Same will go over here. Okay, so same thing will happen even in this case as well. Okay, so what will happen? If I'm willing to become a shareholder in a particular company, I need to come forward, I need to pay the minimal application money. Clear? So always while passing the journal entry, don't look from the perspective of the investor or the shareholder. In whose book are we passing the journal entry? That becomes crucial. If you are passing the journal entry in the book of company, you need to look from the perspective of company. Clear? So what do you think? Company, will it be receiving the application money or will it be paying the application money? Company will be receiving. Okay, if I'm a shareholder and if I'm paying this application money, what will it be for the company? Don't you think for the company it would be a receipt? The company will be receiving this money. So the very first entry would be when the company is receiving this application money. Okay, now let us say Mr. A applied for 10,000 shares. Okay, so by paying rupees 2 per share. So what is this? This is the application money which I am paying, 2 rupees. 10 rupees is the value of share, the minimal amount which I'll be paying. Okay, so that would be the application money. Okay, so here I'm paying how much? I'm paying 2 rupees per share. This would be the application money. If I'm paying for the company, it would be receipt. So the very first transaction for the company will be what? It will be receiving the application money. Okay, let's not worry about the journal entry. I'll explain you the journal entry, but understand the process, what happens. Okay, so first transaction, okay, first transaction for the company will be what? The company receives application money. Okay, and again when it comes to receives, let me just write it in this way. Okay, so company receives the application money. Clear? Okay, now in this case, okay, if A is applying 10,000 shares, okay, he would be paying 10,000 into 2 rupees per application. Totally he would have paid 20,000. Okay, now whenever the company is collecting the amount in installment, you remember the various stages of receipt of this particular amount: application stage, allotment stage and call money stage. Now all these three, don't you think it is a part of my share capital only? Whether it is application money, whether it is allotment money, or whether it is call money, everything ultimately belongs to what? Everything ultimately belongs to share capital. Clear? Now all these amount, okay, so whatever is the amount which I'm collecting either at application stage, allotment stage or call money, that has to get ultimately transferred to share capital. Okay, so the second thing or second transaction will be what? The company transfers the application money to share capital. Okay, so these two are the transaction pertaining to application stage. Okay, so these are the two transactions pertaining to application stage. Okay, so these are the two transactions pertaining to application stage. Then the next thing, okay, so what happens next? We have got two more stages, right? Allotment stage and call money stage. Okay, so what happens is from the second stage and then onwards, okay, so the company has got clear picture. Initially the company won't be having clear picture. If the company is issuing 10,000 shares, the company never knows, okay, whether exactly 10,000 shares will be subscribed by the public. Will it be more than that or will it be less than that? The company will not be having any knowledge about this. Okay, so once people apply, okay, so the company will have clarity about this particular scenario. Okay, so I issued 10,000 shares, 10,000 shares are subscribed by the public. Okay, so after that I know, okay, what I need to do. Okay, so it would be like this. From the second stage and then onwards, what we need to do is we just need to pass something called as due entry and receipt entry. Okay, so due entry and receipt entry. Okay, so we just need to pass the due entry and receipts entry from the second stage and then onwards. Okay, so allotment stage and call money stage. All we got to do is just pass the due entry and receipt entry. Clear? So these are the three things what we'll be doing. First thing is the company collects the application money. After that, what do? They ultimately transfer it to the share capital. Okay, after that, okay, so from the second stage and then onwards, okay, what is the second stage? Allotment stage, and then onwards, that is the call money stage. We just need to pass something called as due entry and receipt entry. So why do you think the company will be passing the due entry first? Because company has got clear picture how much is the amount which is due. Okay, so is it due from 10,000 shareholders, 20,000 shareholders, 30,000 shareholders? The company will have clear picture about the numbers. Okay, so that is why it can pass this entry. Okay, allotment money is due from 10,000 shareholders. Okay, it will have a clear idea about how many number of shares for which the company has to collect this allotment money. Okay, so that's why from the second stage and then onwards it will be passing the due entry first and receipt entry. Now when it comes to first stage, why are they not passing the due entry first? First entry, if you see, they pass the entry pertaining to receipt. Okay, the company receives the application money. Okay, it passes the receipt entry first. The reason is very simple, guys. When the company is issuing 10,000 shares, it will not know what exactly will be the reaction of the public. Okay, so public may either come and subscribe only for 2,000 shares out of those 10,000 shares, or public can exactly subscribe for 10,000 shares, or the public may subscribe even for more. I am issuing 10,000 shares, public may apply for 20,000 shares, possible. Okay, so if the demand for my company share is more public can come forward in order to subscribe the shares. The public may say that you have issued 10,000 but we are willing to purchase 20,000 of your company share. Okay, full subscription, under subscription, over subscription. I issue 10,000 shares, public subscribe for 10,000 shares, full subscription. I issue 10,000 shares, public are willing to subscribe only to the extent of 8,000 shares, under subscription. Over subscription, what is it? I issue 10,000 but public are willing to subscribe for 20,000 shares. Okay, so that is over subscription. Is this clear? Hope you guys understood. So that's why when it comes to the first stage, I won't be having any clear idea like how many public will be interested in purchasing my company shares. Okay, so that's why I pass the receipt entry first and the entire amount is transferred to share capital. Then from the second stage and then onwards, I'll have a clear picture. Okay, so how much is the amount which I'm supposed to receive at the allotment stage? How many shareholders? From how many shareholders am I supposed to receive the amount at allotment stage, and from how many shareholders am I supposed to receive the amount at call money stage? So that's why we'll be passing the due entry first and receipt entry. Okay, now let us understand what exactly will be the journal entries which we need to pass. Okay, so these would be the three things what we'll be doing. Okay, so let us just have a look at the journal entries which we'll be passing. Yeah, so let me just explain you the journal entries what we'll be passing. So I'll just write it over here. So first let me explain you the basic journal entries which will be passing. Okay, so first entry will be what? It would be, you remember this? What would be the first transaction? The company receives the application money. Okay, so the first transaction would be when the application money is received by the company. Always remember, okay, so you need to pass the journal entry. Okay, so from the point of view of the company, okay, you're passing the journal entry from the company's point of view, okay, and not from the point of view of the shareholder. Okay, so always remember you need to pass the journal entry from the point of view of the company. Clear? Okay. When the application money is received, okay, so any amount which I receive, okay, so what would be the journal entry? Now company will not be receiving the amount in the form of cash. Okay, so the amount will be transferred to their bank account. Okay, so the entry would be like this: bank account debtor. Okay, so to what? To share application account. This would be the first journal entry. Okay, so whenever I'm receiving the amount, okay, so the entry will be what? Bank account debtor to share application account. This was the first transaction. Okay, so remember this: company receives this application money. So once the company receives this application money, what does it do with it? Don't you think this amount is transferred to share capital? Ultimately, okay, so everything, whether it is the amount which is received at the application stage, whether it is the amount which is received at the allotment stage, or whether it is the amount which is received at the call money stage, okay, so everything ultimately belongs to what? Everything will be transferred to share capital. All these are nothing but the components of share capital. Only thing is, instead of company receiving the entire amount in lump sum, it is just receiving the amount in installments. Okay, but ultimately these will belong to just a single group, that is the share capital. Fine. Okay, now the second transaction, if you see, okay, look at this: application money is transferred to share capital. Okay, so I'll just show you the journal entry for it. When the application money is transferred to share capital. Okay, now let me tell you the journal entry as well as the logic behind that particular journal entry. I hope this particular entry is clear. Okay, I'm receiving this particular amount, so that's why I'm debiting this bank account, and this is the amount relating to share application. That's why it has been credited. Now this share application money, I need to transfer it to share capital. Now according to this first entry, did I debit the share application account or did I credit it? Yes, did I debit this particular share application account or did I credit it? I have credited. I have debited the bank account and I have credited the share application. Now from the share application, I need to transfer the amount to share capital. What would be the entry? Now let me show you how exactly the share application ledger would appear. Okay, so let me just show it over here. Okay, so let's say this is the share application ledger. Debit and credit. Okay, so let me just show it with figures. So according to this entry, let's assume that 10,000 rupees was received at application. Okay, or if we take the same example which we discussed over here. Okay, so Mr. A applied for 10,000 shares by paying 2 rupees per share as application. Okay, so he would have paid how much? He would have paid totally 20,000 rupees, right? So when I receive this 20,000 rupees, the entry would be bank account debit to share application account 20,000. If I want to do the posting of this 20,000 in the share application ledger, on which side will I be showing it? According to the journal entry, share application is credited. I am preparing this particular share application ledger. So on the credit side, I'll be mentioning by bank account 20,000 rupees. Clear? So by bank account 20,000 rupees. Now look at the next transaction. This 20,000 rupees, I need to transfer it to share capital. So this particular ledger is showing a credit balance of 20,000 rupees. I want to transfer. If I want to transfer, where do you think will I be writing this 20,000? Should I again write it on this credit side or should I be writing it on the debit side? Yes. If I write this 20,000 rupees again on the credit side, it would be as good as I'm adding another 20,000 rupees to this ledger. Okay, it wouldn't be that I'm transferring from this ledger. But what are we supposed to do actually? we are supposed to transfer this 20k from this share application account and we need to transfer it to share capital. So don't you think this 20,000 rupees I need to write it on the debit side? I want to transfer this 20,000 rupees to some other ledger. So I need to eliminate this. If I want to eliminate something from a ledger, I'll always be showing it on the opposite side. If I show it on the same side, it would become as good as I'm adding it to the value of the ledger. So what I do is, I just write this 20,000 rupees on the debit side. Now where am I transferring this share application money? I'm transferring it to share capital. So here I'll just be writing to share capital account. Now, if you just look at this particular part, what do you think will be the journal entry? By looking at the ledger, you guys can arrive at the journal entry, right? So which account am I debiting? I'm debiting the share application account. Share application account debit to what? To share capital. Okay, so this would be the journal entry. Okay, so if you just have a look at this, the journal entry would be like this: share application account debit to what? To share capital. So this would be my second journal entry. Clear about the logic? So in the first journal entry, I had credited the share application account. Now I'm just debiting it. Why? Because I want to transfer the money from the share application account to share capital. Okay, so that's why I'm debiting it. So this would be the entry. Okay, now the ultimate journal entry. Okay, so what will be the ultimate journal entry with respect to issue of shares? Or let's not worry about issue of shares. Let us say Mr. A started the business. What would be the ultimate entry? Mr. A started the business by contributing 2 lakh. What would be the entry for this? The entry for this would be cash or bank account debit 2 lakh to A's capital account. This would be the entry. Correct? So bank account I'm debiting and capital account I'm crediting. Here also if you see, okay, so the ultimate entry would still be same. So share application account debit over here. Just a second. Yeah, share application debit over here and share application credit over here. This will get nullified. Okay, so this will get eliminated. So what is left over? Don't you think it is just bank account debit to share capital account? So here we just called it as A's capital account because it was proprietorship, but in case of company we'll be calling it as share capital. Okay, so all these intermediary ledger. Okay, so here if you see share application account, it is closed, 20,000 on the debit and 20 on the credit. All these intermediary ledger, whether it is share application ledger, whether it is share allotment ledger, or whether it is share first and final call ledger, all these intermediary ledger will get closed ultimately. Okay, so ultimately only one single entry will be passed, that is bank account debit to share capital account. Okay, so only thing is we cannot pass this single entry, okay, because various amounts will be received on different dates. So that's why you need to have knowledge about what entry are you supposed to pass at application stage, what entry are you supposed to pass at allotment stage, and what entry are you supposed to pass at call money stage. Is this point clear? Hope you guys at least are getting fair bit of idea. So try to remember these would be the journal entries. Okay, so first entry would be bank account debit to share application account. The next entry would be share application account data to share capital account. Okay. Okay, so let's talk about this third entry. Okay, so from here on, okay, so the allotment stage would begin. Okay, so this is allotment stage. Okay, so this was actually the application stage. Okay, so this was application stage. Now let's talk about the allotment stage and call money stage. Okay. Yeah. Okay, allotment stage. So if you guys remember this particular discussion, what did I mention? So when it comes to allotment stage, so we'll be passing the due entry first and then the receipt entry. Remember this? Due entry and then the receipt entry. Okay, so 1 second. Look at this. We pass the due entry and then the receipt entry. Okay, so these are the two things what we'll be doing. Okay, so we pass the due entry as well as the receipt entry. Okay, yeah. Now let me tell you, okay, so what exactly will be the due entry which we need to pass at allotment, and what exactly will be the due entry which we need to pass at call money stage. Okay, so let me take through the journal entries. So here you will be passing two things. So one would be the due entry So what is due entry? It is as good as when allotment money is due. Okay, when allotment money is due, what exactly will be the entry? When it is actually received, what exactly will be the entry? Okay, as simple as this. Okay, so I hope the logic is quite clear. Okay, so why we did not pass the due entry first and receipt entry first when it comes to application stage? Application stage, the company will not be having any idea like how many shares will be applied by the public. Only when public apply for the shares, the company will know that these number of shares have been applied by the public. Okay, so that's why we pass the receipt entry first and then we transfer it to share capital. But from the second stage onwards, the company will have clear picture. Okay, so these are the number of shares for which I need to make the allotment. Okay, so that's why the company will be passing the due entry first. Okay, so the due entry would be like this: share allotment account data, okay, to share capital. This would be the entry. Okay, so exactly similar to this entry, guys, no changes at all. Only thing is here we call it as share application account, whereas here we'll be calling it as share allotment account. Okay, so share, instead of share application, just replace it by share allotment, nothing else would change. Okay, everything is same. So share allotment account data to share capital. Okay, so then the receipt entry. Okay, when I actually receive this particular amount. Okay, so let us understand what exactly will be the entry. Now whenever I receive any amount, don't you think bank account will come into picture? When I'm receiving any amount, I need to debit this bank account. Whenever I make the payment, I'll be crediting the bank account. So I'll just pass the entry like this: bank account data to what? From what stage am I receiving this? So I'm receiving this amount from share allotment stage to share allotment account. Exactly similar to the entry what we passed. Okay, the first entry. Okay, what was the first entry? Just have a look at this: bank account data to share application. When you are receiving the application money, what entry did you pass? Bank account data to share application. When you are receiving the allotment money, what should be the entry? Bank account data. Instead of share application, it would be share allotment. As simple as that. Okay, so here also, if you guys observe carefully, okay, look at this. This is an intermediary account, share allotment account debit over here and share allotment account credit over here. Even this will get nullified. Okay, ultimately wherever you see, the ultimate entry would still be the same: bank account data to share capital. The ultimate entry is not going to change. Clear? Remember, I told you all these intermediary ledger, whether it is share application account, whether it is share allotment account, or whether it is share first and final call account, all these intermediary ledger will get nullified. Clear? Clear? Okay. Now, when it comes to the third stage, what is the third stage? The third stage is call money stage. Okay, the same entries, guys, nothing would change. Okay, so when it comes to third stage, this would be called as call money stage. Again, we need to pass the same due entry and the receipt entry. Okay, so look at this. I'm just copying, pasting over here. Okay, just copy, paste. Only thing is, instead of calling it as share allotment account, what would you call it as? You will be calling it as share first and final call. Okay, so okay, share first and final call account. Okay, so the due entry would be like this: share first and final call account debit to share capital, because ultimately everything has to be transferred to share capital. So therefore, everywhere if you guys observe, share capital is credited. Okay, and then when I actually receive, when application money was received, what was the entry? Bank account data to share application. When allotment money was received, bank account data to share allotment. When call money is received, obviously bank account data to first and final call account. Okay, so this would be the entry. Okay, so clear about this entry: bank account data to share first and final call. Clear? Okay, so this would be the receipt entry. Okay, so first stage, that is application stage, the first transaction would be what? When I'm receiving the application money. Okay, bank account data to share application account. Okay, then what are we supposed to do with this amount? This amount has to be transferred where? This has to be transferred to share capital. Okay, so the entry will be what? The entry will be share application account data to share capital. From the second stage and then onwards, we just need to pass the due entry first and then the receipt entry. Clear? So what would be the due entry? So share allotment account data to share capital. When I actually receive this amount, bank account data to share allotment account. Same entry over here. Okay. So due entry will be what? Share first and final call account data to share capital. And what would be the receipt entry? The receipt entry will be bank account data to share first and final call. Is this clear? Hope you guys understood this. Clear? I hope the entries are visible to you all. Okay, I'll just increase the size a bit. Yep, that's all guys. If you remember these basic entries, more than sufficient. Along with these basic entries, few more add-ons will be there. Okay, so what in case the shares are issued at premium? Okay, so what in case there was over subscription of the shares? Okay, so what in case there was under subscription of the shares? Okay, so what in case if we need to refund the excess application money? All these things we'll be discussing, okay, going forward. Okay, so but these basic journal entries, these are the one which will be foundation. Okay, so try to remember these particular basic journal entries. Okay, other things will be add on. We just need to either decide whether to debit this particular account or credit with logic. Okay, so I'll be explaining with logic why this particular account has to be debited and why exactly this has to be credited. And try to remember this ultimate entry wherever you see guys. Okay, it would be bank account debit to share capital only. All these intermediary ledger which I've highlighted in yellow, okay, so these will get nullified. Even in this case, if you see share first and final call account debit, and here in the second entry it has been credited. Look at what is left over. Don't you think bank account debit to share capital, this is what is left over, right? Getting my point? Correct. So ultimate journal entry would be what? It would be bank account debit to share capital. Clear? Okay. Fine. Look at this. The same entries whatever we discussed, it has been given over here. On receipt of application, the entry will be what? The entry will be bank account debit to share application account. So for excess share application money refunded, this entry we did not discuss it, right? Correct. We will be discussing when it comes to over subscription of the shares. Okay, so what is over subscription? Let me just explain it over here. Okay, so let's say, just a second. Okay, so let us say in case of over subscription, what exactly would happen? Okay, so one moment. Yeah, let's say the company issued 10,000 shares. Understand this particular example carefully. Okay, so the company is issuing how much? It is issuing 10,000 shares. Okay, so public applied for 12,000 shares. Okay, so public is applying for how many shares? It is applying for 12,000 shares. Okay, now understand this, the company issued only 10,000. Can they allot more than what they issued? Not possible, right? Correct. If I've got only 100 seats, okay, and if 500 students applied in my college, will I be able to accommodate all the 500? Not possible, right? Correct. So based on some criteria, I need to select, okay, only 100 students, and remaining 400 students I just need to reject. Okay, same will happen even in case of company. Company has issued only 10,000 shares, so it can allot only 10,000 shares. Okay, but what happened? Public applied for more than that. Okay, so public are willing to purchase 12,000 shares. Okay, now company would have collected, you guys think and tell me, for how many shares do you think the company would have collected the application money? Okay, so if application money, let's say 2 rupees. Okay, so if application money is 2 rupees, tell me the company, okay, so what do you think? They would have collected the application money with respect to 10,000 shares, or what do you think? They would have collected the application money pertaining to 12,000 shares. How many shareholders applied actually? Was it 10,000 shares which was applied by the public, or was it 12,000 shares which was applied by the public? Don't you think it was 12,000 shares which was applied by the public? When public are applying for 12,000 shares, for each application they would have paid this 2 rupees. Okay, so company, okay, would have collected the application money with respect to these 12,000 shares and not pertaining to those 10,000 shares. Okay, when public are applying for 12,000 shares, for each share they would have paid 2 rupees as application money. Okay, now you remember the first entry, right? So what would be the first entry when the company is collecting this application money? Yes, the entry would have been like this. The company would have passed an entry like this: bank account debit. Okay, so 12,000 shares is what is applied by the public into 2 rupees. Okay, so this would be what? This would be 24,000 to what? To share application account. 24,000. This would be the journal entry which would have been passed by the company. Bank account debit 24,000 to share application account 24,000. Now tell me, how much is the amount which the company was actually supposed to collect? Was it supposed to collect the application from the 10,000 shares, or was it supposed to collect the application from 12,000 shares? The company was actually supposed to collect only with respect to these shares what they issued. So technically the company was supposed to collect how much? So 10,000 shares into 2 rupees, that is 20,000 rupees is what the company was actually supposed to collect. Okay, so this is the amount which was supposed to be received by the company. Okay, so this is the amount which was supposed to be received by the company, but the company actually received how much? The company actually received 24,000 instead of 20,000. Now what about this 4,000 rupees of excess application money? So company has collected, I'll just write it over here. So company collected 4,000 extra, or you can call it as excess amount. Okay, so 4,000 rupees extra. This will be called as what? This is called as excess application money. Okay, so this is called as excess application money. Now what the company is supposed to do with this excess application money? This has to be refunded. Okay, so this excess application money has to be refunded. Now when the company is refunding it, okay, what do you think the money, is it coming into the company or is it going out of the company? Here they received the money. Okay, in the first transaction they received the money, therefore they debited the bank account. Now when they're refunding the amount back to the shareholders, what should be the entry? Don't you think we need to be passing the reversal of this first entry what we have already passed? Correct? So the first entry when we received the application money, what was the entry? Bank account debit to share application account. Now out of this 24,000, if I want to refund 4,000 rupees, okay, I'm repaying this 4,000 rupees, I just need to reverse this first entry which is already been passed. So this particular first entry which is already been passed, this entry has to be reversed. Okay, so what will be the reversal of this entry? Debit the credit and credit the debit, as good as this. Okay, so whatever account was debited, just credit it now, and whatever account was credited, just debit it. So the entry would be what? The entry would be like this: share application account debit. Am I refunding the entire 24? No. How much am I refunding? Only this excess application money which was collected, only 4,000. Okay, 4,000 to what? To bank account. Very simple entry, guys. Whatever account was debited earlier, I'm just crediting it now, and whatever account was credited, I'm just debiting. Here bank account was debited earlier, here if you see it is credited. Share application account which was credited earlier, if you see, I'm debiting it over here. Simple. Hope you guys understood it. Same will be the entry which is available in your study material. Just have a look at the entry which is available in your study material. So here if you see, for excess application money refunded, look at the entry: share application account debit to bank account. Don't you think this is exactly reversal of the previous entry? When I receive the application money, okay, so bank account debit to share application. When I refund, share application account debit to bank account. As simple as that. Clear? Hope you guys understood this. Clear? So this would be the entry. So when I'm receiving this application money, bank account debit to share application. Same way when I'm refunding it, just reverse the entry. Okay, so share application account debit to bank account. This would be the entry. Hope things are clear. Yes? All right. Okay, so let me just write this particular entry over here. Okay, so I'll just write it down over here. When excess application money is refunded. Okay, so all we need to do is what? Just reverse. Okay, so just reverse the previous entry, that is the entry would be share application account data to bank account. This would be the entry. When I receive the amount, I just debit the bank account. When I'm paying the amount, I'll just be crediting the bank account. As simple as that. Okay, so this will happen in case of what? When excess application money is refunded in case of oversubscription. You understood what is oversubscription, right? Yes, I am issuing 10,000 shares, but people are applying for 12,000 shares. Okay, so people are willing to subscribe more than what I'm issuing. Okay, so that is the situation of oversubscription. Clear? All right. Okay, so when it comes to allotment stage and then onwards, you guys already know. Okay, so first we'll be passing the due entry. Okay, and then the transfer entry. Okay, that's the receipt entry, due entry, and then the receipt entry. So this is nothing but the transfer entry, share application account data to share capital account. So this entry we have already written. Look at this, share application account data to share capital. This is the entry what will be passing when we are transferring the application money to share capital. Remember, I told you ultimately doesn't matter whether the amount is collected at application stage, allotment stage, or call money. Ultimately all these stuff has to be transferred where they belong to a single group called as share capital. Clear? And remember, all these intermediary ledger, whether it is share application, whether it is share allotment, or whether it is share first and final call, all these intermediary ledger will get nullified. Clear? All right. Okay, so let's have a look at this particular illustration. Okay, so illustration number 1. So we'll be solving this. As I already told you initially that we'll be solving each and every illustration which is there in your study material. Okay, so don't worry about it. So let's just have a look at this illustration. Let me just read this illustration first. Okay, so it goes out like this. AK Limited made an issue of 10 lakh equity shares of rupees 10 each. So 10 lakh is the number. Okay, so here if you see this 10 lakh is the number. Okay, so 10 lakh equity shares of rupees 10 each. Okay, just a second. Yeah, so look at this 10 lakh equity shares of rupees 10 each. Okay, so 10 rupees is the price per share. Okay, payable fully on application. Look at this, fully on application. So they're not collecting the amount in installment. This entire amount is collected in one shot. Okay, that is in the application stage itself. Okay, so subscribers were received, okay, for 12 lakh shares. Okay, so the company is issuing how many shares? The company is issuing 10 lakh shares. Okay, but people or public applied for how many shares? They are applying for 12 lakh shares. Okay, so what do you think? Is this a situation of full subscription, over subscription, or under subscription? I've already told you the meaning of this. If I'm issuing 1 lakh shares and if public are subscribing for 1 lakh shares, it is full subscription. If I'm issuing 1 lakh shares and public are willing to subscribe only to the extent of 80,000, it is under subscription. I issued 1 lakh, public came forward and applied only for 80,000 shares. This is under subscription. I'm issuing 1 lakh shares, but public are willing to purchase for 1.5 lakh shares. That would be treated as over subscription. So in this case, it is clearly a sign of over subscription. My second question to you guys would be, in this case, what do you think? The company, okay, it would have received the application money with respect to those 10 lakh equity shares, or which was actually applied, that is 12 lakh equity shares. Think about it. Application stage, don't you think public, whenever they want to apply for the shares, they'll be paying the application money? So in this case, although the company issued only 10 lakh shares, 12 lakh shares is what was applied by the public. Okay, public are applying for 12 lakh shares. Obviously they would have paid the application money for 12 lakh. Exactly the same situation what I told over here. Okay, so you remember this, the company issued 10,000 shares. Okay, but look at this, public applied for 12,000 shares. Okay, when I pass this particular receipt entry, okay, so this entry, don't you think I passed it for 12,000 shares? 12,000 shares into 2, right? So same has to be done even in this case. So even in this case, if you guys see, although the company issued 1 lakh shares, sorry, 10 lakh shares, public applied for how many? They applied for 12 lakh shares. Okay, so ultimately we need to be passing the journal entry of receipt. Okay, that is application money received for how many shares? It would be for 12 lakh. application money in respect to 2 lakh shares was refunded. Okay, so they have clearly mentioned that excess application money is being refunded. Okay, and shares were duly allotted to the rest. Pass the journal entry and give effect for these transactions. Okay, so very simple transaction. Okay, so I'll just write it over here. So illustration number 1. Okay, so the company issued 10 lakh shares of rupees 10 each, receivable completely at application stage. Okay, so here the amount is not received in installment. Okay, so entire amount has been collected at application stage itself. Okay, whereas public applied for 12 lakh shares. Okay, so then what did the company do? The company refunded the excess application money of 2 lakh shares. Clear? So basically here we need to be passing 3 entries. Okay, so entry number 1, when I am collecting this application money. Okay, so when application money was received. When application money was received, what would be the entry? Yes, tell me, am I receiving the application money for 10 lakh shares or 12 lakh shares? So in this case, I'll be receiving the money with respect to 12 lakh shares. Okay, so the entry would be bank account debit. Okay, so this would be like 12 lakh into entire 10 rupees was collected. Okay, so this would be what? This would be 120 lakh. Okay, that is 1.2 crores. To what? To share application account. Okay, so to share application account, again the same amount. Okay, so 120 lakh. This would be my first entry. Clear? Because public applied for 12 lakh shares. Okay, and at the time of application only they are paying this entire amount of 10. Okay, so 12 lakh into 10 rupees, that would be 120 lakh. Okay, now out of this, okay, how much is the excess application money which was received? Excess application money was received to the extent of 2 lakh shares, because the company issued only 10 lakh, public applied for 12 lakh. So excess application is to the extent of 2 lakh. Okay, so the entry for refund of excess application money. So what am I supposed to do? I just need to reverse this entry. Okay, so whatever entry which I passed over here, I just need to reverse it. So entry will be what? The entry will be share application account debtor. Okay, so to the extent of 2 lakh, 2 lakh shares is what I need to refund. 2 lakh into 10, that is 20 lakh. To what? To bank account, because I am literally paying the amount back to them. Okay, so to bank account. Okay, so this would be my entry number 2. Okay, this is the entry for refund of the excess application money. Now the remaining amount pertaining to those 10 lakh shares. Okay, so don't you think I'm supposed to transfer it to share capital? So the entry for transferring the application money to share capital. Now let us understand what exactly will be the entry when I'm transferring this application, okay, money to share capital. You already know it. If you guys are getting confused, just prepare this particular ledger, guys, just like how I showed you over here. Okay, so look at this. Just prepare this ledger. Okay, I'm just writing this ledger just to make you guys understand. Okay, so nowhere a part of solution. So fine. So here, how much did I receive? I received 120 lakh. Okay, so out of this 120 lakh, in the second entry, if you see share application account, I'm debiting. Okay, I'll just go to the debit and I'll just write to bank account. Okay, so this is the refund part. Okay, how much did I refund? I refunded 20 lakh. Now if you just close this particular ledger, okay, if you just close this particular ledger, 120 lakh is more on the credit. Okay, so same 120 lakh, I'll be writing it on the debit side. 120 minus 20, 100 lakh is what I need to transfer it to share capital. So if you guys already remember the journal entry, what will be the entry? You guys can go back and check. Look at this. Share application account debtor to share capital. You remember this? When the application money is transferred to share capital. Okay, share application account debtor to share capital. Same entry I'll be passing over here. Okay, so share application account debit to the extent of 10 lakh. Okay, so 10 lakh into 10. Okay, so this would be 100 lakh to what? To share capital account to the extent of 100 lakh. This would be our last entry. Clear? You just check out the solution, it would be exactly the same thing. Look at this, bank account data to share application. This is, no, not this. The amount they have written it wrongly. Look at this narration. Share application money of 12 lakh shares, okay, at rupees 10 received. So obviously 12 lakh shares into 10, don't you think it would be like 120 lakh? This figure is wrong, guys. Okay, so this is not 10, this is something which is wrong. Okay, 1 second. Clear? They have clearly mentioned that 12 lakh shares. Okay, for 12 lakh I'm receiving this. See, this amount, this should not be 100 lakh, it should actually be 120 lakh. Okay, so 12 lakh into 10, this figure is wrong. Okay, so the actual entry would be this. Okay, this is the correct value. See, I'm receiving 10 lakh, I'm transferring 10 lakh, then what's the logic of this particular 20 lakh? Are you guys getting my point? Here I received excess, this figure is wrong. Although the entry is correct, this should not be 10,000, this should be actually 20,000 over here. Okay, and this should be 2,000, this is correct. Okay, so share application to bank account, this would be the entry for refund of the excess application. Okay, and then the third entry, share application to share capital, yes, correct amount, 100 lakh and 100 lakh, this would be correct amount. But this figure what they have written over here, this is not the correct amount. Okay, so this should be 12,000 and 12,000. Okay, all the amounts which they have given is in thousands over here, so therefore it should be 12,000. Just make this slight correction in your study material. This is not 100 lakh, it is actually 120 lakh. Okay, so you guys can refer to this particular entry. This should be the value. Is this clear? Okay, so we have had a basic understanding about this particular thing. Okay, so look at the journal entries. Here it's the same entries what we had discussed. Okay, so share issued in installment. First entry, when I receive bank account debit to share application, then when I refund this, okay, reversal of the first entry, then when I transfer this application money to share capital, look at this, share application to share capital. After this, from the second stage and then onwards, it is just the due entry and receipt entry. When the share allotment money is due, look at this, this is the due entry. Share allotment account debit to share capital. When I actually receive, okay, so this is the receipt entry. Bank account debit to share allotment. The same entry is what we have already written, guys. Nothing new. Exactly the same entry. Share allotment to share capital and then bank account debit to share allotment. Look at this. Same thing will go on for the last stage also. Okay, same thing, the due entry and the receipt entry. What would be the due entry? Instead of calling it as share allotment, here call it as share call account. Whether it is first call, second call, okay, depending upon the illustration. Okay, so share first and final call account debit to share capital. When I actually receive, bank account debit to share first and final call. Okay, so these would be the basic journal entries. Is this clear? Okay, so we'll stop over here. Okay, so I want you guys to go through these stuff, and by the next class, okay, just have a thorough grip about these particular entries. Okay, so all these entries whatever we discussed over here, okay, the entries pertaining to application, allotment and call money. Okay, just go through these particular entries and try to remember them. Okay, so in the next class we'll be starting straight away from this illustration number 2. Okay, so make sure you guys go through the stuffs whatever we discussed on that particular day itself. Okay, so remember the very first class, what did I ask? I just need one thing from you guys. Okay, so whatever is being done in that particular class, just try to cover up in that particular class itself. Okay, okay guys, thank you so much.